Welcome back to Real Estate Mindset. I thought it was appropriate to go live, being that the entire global economy appears to be possibly at the point where it's maybe collapsing. So I have a Mitch Vexler here with us today to kind of help figure out what the heck is going on. I've already done a morning video. I woke up at 2 a.m., about 2:30 a.m., put that sucker out. I was emailing Mitch. I'm like, Mitch, oh my God, what's happening? And the reason we want to come live, guys, is there's a lot happening. And I want to point and direct your attention real quick to the potential that today we actually may close uninverted, which is a huge deal. But right now, the 10 years sitting at 3.76, the 2 years at 3.84. So no uninversion yet. But take a look at the VIX, you guys. This is a huge shocker. I missed this in my morning video. The VIX is absolutely exploding right now, up 80%. So I don't know if anyone made any volatility moves, but if you did, holy smokes, you guys are killing it and crushing it right now. Also, breaking news with Bitcoin. Bitcoin is also down double digits. Absolutely shocking stuff going on right now, down 12.74%. I mean, there's a lot going on in the market. The markets are down right now. Let's see here. And we're going to give you guys live breaking information as well. I'm going to get some reactions from Mitch. We're going to talk about Japan. We're going to talk about all kinds of stuff. But right now, you guys, the Dow is down almost 1,100 points. S&P down 173. NASDAQ down 665. Mitch, I want to say good morning real quick. I want to get your reactions, but Jason, really appreciate you. This is my dude right here. I didn't mean to dox myself. I doxed myself, Mitch. This is my dude. He's like, brother, you doxed yourself. I'm like, there's no way I doxed myself. He's like, yeah, you were facing west when the sun was east, and I found out where you lived. This is my buddy. Him and I are going to walk new home construction together, and we're going to try to not set up realtors, not set up to hear fraud, but this is my dude. I'll be reaching out to you, brother. Sorry for the lag. He knows that I ran out to see you, Mitch, for that whistleblower story. So Jason, I really appreciate you. There's Christy, there's Johnny, there's everyone, SMB, everyone. Really appreciate you guys. There's my buddy right here. This is Austin. Mitch, this is the dude. This is the community of Real Estate Mindset. Absolutely amazing community. So Mitch, what's going on in the markets, buddy?
NASDAQ hit a double dip about an hour and 10 minutes ago. It was down 1120. Right now, I think it's down about 500. So you have to take everything in context. It's not that this wasn't long time in coming. And it really does tie back to what we've been talking about over the last week, which is the fraud that's induced into this marketplace, and from housing prices all the way up to the pension funds that are participating, i.e. through entities like Caisse de Depot out of Montreal in Canada. So they have massive amount of pension holders. CalPERS has got a massive amount of pension holders. The problem is that they're playing with other people's money. So they get a 2 and 20 fee, generally speaking, or some type of fee. They take the pensioners' money, they put it in the stock market. The problem is it's unhedged.
Austin Goolsby.
So when you understand what's going on, again, mom and pop, no matter what angle you look at, be it in the bonds, in the stock market, if they're unhedged, and they don't have the ability to hedge around their positions, they're screwed.
I mean, it looks like they're screwed right now, Mitch. I mean, it sounds like there's a possibility of, that the interest rates may be cut prior to September. Let's listen to the Chicago Fed real quick, and let's get your reactions on that real quick, Mitch. Let me push play. A lot of crazy things. Again, they may meet before September to cut interest rates. Let's see what they have to say.
Austin, thanks for joining us this morning.
Can you guys hear audio okay?
Good to see you again, Steve.
So, Austin, there's a perception out there that the economy is either in or close to a recession, and the Federal Reserve is about to embark perhaps on an emergency cut or a series of rate cuts that will slash the federal funds rate. I'm wondering if you could comment on where the market is priced and also what your perception is or your outlook is for the economy and the funds rate.
Well, look, Steve, that I'm not allowed by rules to talk about what happens at the meetings or anybody's opinion but my own. I've been saying to you for a long time that we've been in a restrictive posture at the Fed. If you look at the Fed funds rate minus inflation, the real Fed funds rate is as high as it's been in a long time. And we're at the peak, even in this cycle, as inflation comes down. And you only want to be that restrictive if you think there's fear of overheating. and that these data, to me, do not look like overheating. So I think the Fed is forward-looking. The Federal Reserve Act gives us a straightforward job to stabilize prices and maximize employment, and that's what we're going to do. And so as you see jobs numbers come in weaker than expected, but not looking yet like recession, I do think you want to be forward-looking of where the economy is headed for making the decisions. And remember that, say, the payroll jobs number is plus or minus 100,000 a month. So be a little careful over concluding about things in the margin of error.
Would you step back, Austin, and maybe sort of put it in context? Jobs number was probably the worst number we've had. We've also had a bad ISM manufacturing index. Are there other indicators out there that suggest to you that we've missed the idea that this economy is in recession or about to go into one?
Yeah, the manufacturing's a little complicated for the reason that we went through a pandemic with a downturn where spending on physical goods went up very unusually compared to previous business cycles. So you knew that as people shift back what they're spending towards services and away from manufacturing, that there would be some weakness in manufacturing, even separate from the business cycle. So we gotta calibrate that one, and it's not as easy. Now, that said, there are other cautionary indicators that I've been citing for a long time, like the rise in consumer delinquencies, the rise in small business defaults. Those things have been trending the other way, and now they're to levels that they have not settled at levels that you think of as being during boom times. On the other side, if you look at domestic purchases, the GDP number was relatively stronger than we expected.
Right.
The previous one was a little weaker than expected, but in total, that the economic growth continues still at a fairly steady level.
Also, I want to ask this outright. The market is priced for 150 basis points or more of cuts by through January, for a 50 in September. Is the market over its skis here? Do you think it's sort of embraced a panic about the economy that you don't have?
Well, look, you know, I never like binding ourselves ahead of time before meetings, even a single meeting, much less 5-6 meetings from now, because we're going to get a lot of information. It seems like there's a lot going on in the world as well. You got the Bank of Japan raising rates when everybody else is cutting rates or thinking of cutting rates. And so you got movements in the exchange rate. And so the international component of this is probably a little more complicated. I think the market's reaction, if you just plot out what their projected Fed funds rate will be and plot it against what the actual Fed funds rate does, you can see that it's the market's job to react and it's the Fed's job to act. And
Alrighty, let me kick you off. I muted you guys just because there's an echo. I want to start. First of all, good morning, Jack. Nice to see you, brother.
Good morning, Travis, and hello, Mitch. Good to see you again.
Hi, Jack.
No rest, huh? I see you got off your morning stream and jumped over here. My first question is going to be to Mitch. You know, after hearing that, you know, what do you think the likelihood is that there isn't maybe some type of emergency meeting and that they cut before September? And what do you think needs to take place, Mitch, for that to happen?
Okay, couple points. First one is markets do what they do, which means there's a series of standard, random, normal variables. The problem with what you just heard from Goolsbee is that the Fed, since its creation, has never been in front of a disaster. They have never been in front of a market downturn. They are 100% reactionary. And because they are reactionary, there's an extraordinarily high probability that if this market closes down below that double dip from this morning, within the next day, they will have an emergency meeting and they will say, fine, we're going to lower interest rates. What happened last week, when you saw the interest rates drop so dramatically on the 10-year, is the market basically playing a game of chicken with the Fed. And there's a very high probability. If we close, if NASDAQ is down at 1,100 or 1,200 on the close, you can bet they're in Washington sweating bullets.
Mitch, I'm pretty sure, judging from the stock market, there's a lot of people sweating bullets right now. Am I right?
Well, it's up off the lows at the moment, but we have the day
Yeah.
to go, and that'll be the proof in the pudding.
And it was a bloodbath pre-market. Real quick, want to say thank you to Danny J. Driving for your support. Obviously, it's viewers like you that keeps us running. I don't sell anything, so thank you for your support. We are trying to create overwhelming value. Now, Jack, I want to move on to, different markets, even listen to Kramer, but did you want to add anything right there?
To Kramer?
As far as
whatever Kramer says, in the opposite side right now. Tell me what he said.
We're going to listen to Kramer.
On our way to success. Yeah.
We'll listen to Kramer here in a minute. But Jack, do you want to respond to anything Mitch just said, or do you think that they're going to meet prior to September to cut rates? And if so, why?
Let me just say, the cliche to a hammer, everything
$10.
nails. All right. And right now we are in this mess because of central banks. All right. Central banks created inflation when they told us there would be no inflation. Remember, transitory, still fresh in everybody's mind. And then the Fed said, soft landing, don't worry, unemployment's not going to spike. Whoops, how's that going? 4.3% just on Friday. And now here we are, a few minutes into a sell-off created by central banks in Japan and their idiotic modern monetary theory of yield curve control and endless QE. And what set this in motion? Japan raised interest rates from nothing to 0.25%, and the market is freaking out. And the first thing the Keynesians and the financial press are saying is, we need more central bank involvement. Maybe nothing is the best thing to do here. Maybe just stop messing with things. Let the market find out what all this garbage is really worth. Maybe don't mess with it. And let me just tell you this, Trav, if they do an emergency rate cut, all right, that would be the Fed again and saying we got it wrong the second time in 2 years. What happens if right now, while everybody is still remembering transitory, if everybody still is being crushed by the inflation that has already happened, it's slowed, but the cumulative price hikes are strangling consumers. And the Fed comes in and now says, emergency rate cut? What is that going to do to inflation expectations? Not inflation itself, expectations. What are people going to think inflation is going to do? They're going to think the Fed has lost control again. And when inflation expectations rise, they drag long-term interest rates higher with them. So an emergency rate cut from the Fed here, and if they fire up their bazooka and they go Zerpenber again, if they're not careful, they might accidentally have the opposite effect on the desired target. They might send long-term interest rates higher, caused by a lack of faith in the central bankers. So this is not as simple as just spin the money printers back up again. They might make it worse if they do that. This is a central bank created problem. More central bank involvement will only make it worse.
Which is exactly why what I was saying before the other day was, in truth, the Fed doors need to be chained. Everything Jack just says 100% dead on point, but it's kind of even worse in that, he was talking about MMT. I call it MMT, magic money theory. It just simply isn't real because the Fed is nothing more than a reaction. Who are they reacting for? Well, they're reacting for the benefit of the banks, and which are directly to the benefit of the market. And therein is why you go full circle back to the magic money theory. If they stop the nonsense and bring truth back to the markets, we wouldn't be in this predicament in the first place. All these pension funds and all these people that are tied to this and all the mortgages, it's all tied to one giant fraud. And they can either get in front of it and fix it, or it will run everybody over. It's just how the math works.
Speaking of how the math works, let's listen to Kramer now, because we know to do the opposite. I don't know. I heard you're supposed to do the opposite of Kramer. I'm not a stock guy. People clown on me all the time. But let's listen to Kramer. I'm going to put you guys on mute real quick because I think there's an echo. Let me tee this up. And, if we could get your reactions on whether or not should we listen to Kramer, should we not? And how the hell does this guy have a show still?
All right, let's get to a mad dash. We have an opening bell 3 minutes from now. Not going to want to miss that. See where stocks sort of begin what is going to be a significantly down day. Speaking of down, Intel shares down sharply on Friday on just a slew of bad news, but you want to make that the feature of the mad dash?
I do, because I think that what's happened here is they're spending a lot of money on fabs that they don't really have any customers. Part of that is the commitment to the United States, but that's not necessarily what you want when you want to commit to customers. I also think, by the way, David, there really is, I want to be a little diplomatic here, but there's a sense that the company is really in much worse straits than we realize. I asked Secretary Raimondo a couple weeks ago whether she was concerned about Intel. No. Some of that's because they have Apollo. Some of it's because they have Brookfield.
Well, Apollo and Brookfield, just to be clear,
50,
are partners in fabs, and they provided a significant amount of the capital,
Right.
because obviously Intel has been capital constrained,
Yes.
and is even more so, which is why they're cutting the dividend, cutting back on CapEx, in part because they're trying to get to this day where these fabs are going to be up and operating, and that they can reclaim what Gelsinger says is their rightful place as a leader.
Well, I love the attitude, but they don't have the horses.
What do you mean when you say the horses?
You have to spend a fortune to get these things going. We moved our foundries to Taiwan because it's much cheaper. He's going full bore, Gelsinger, in the most expensive areas. I thought his conference call was, it was frankly unconscionable.
China
and also,
were to invade Taiwan,
Not
that
an
would
issue.
change everything then, right?
Well, they
Wouldn't
need geopolitical.
Yeah.
They actually need you. I mean, there's something. Like, yes, it'd be a safe zone if China. I don't even want to put that out there, but I thought he was incoherent on the call. And a lot of the questions were directed to the CFO after because of his incoherence. I don't think that he realizes how big the problems are. And I think, ready?
Yeah, I'm ready.
I think it's really over his head.
I'm sorry, say that again?
I think it's over his head.
Over his
Yeah,
head.
because I think you've got Dell and Lenovo and their HP trying to figure out if they need to do a second source. You have Lisa Su so ready to do anything they need. He missed remember, in 2009, he was let go by Intel because he was doing graphics. Well, who won in graphics? Nvidia. So I just think that there's a little history here. Not presume.
All righty, then let's start with Mitch before you blow it up, Jack. Mitch, you better step up, man. Jack is on fire. I don't know how much coffee that man has had, but he is ready to roll. Mitch, any value there? Is Intel in trouble? Anything we can gain
Absolutely.
from that?
Kramer was right. He was absolutely right. He is completely incoherent. You can't have a conversation unless you can quantify what's coming out of your mouth. And he may be perfectly right on Intel, and he's entitled to his opinion. But the bottom line is, I wasn't aware that we're supposed to be quantifying how many horses Intel has. And therein lies the problem. You've got a lot of talking heads that are causing these problems that blow up out of proportion. And the market will do what it does. And it is nothing more than reversion to the mean in two levels. It's reversion to the mean in price. And even though the VIX spiked early this morning to 52, it will be reversion to the mean in terms of the VIX. So it spikes to 52. I think a half hour ago it was down to 42. These are normal quantified moves that are happening in the market, which can be predicted on a short-term basis. So panicking does nothing good for anybody. And the problem when you have these shows like CNBC is putting on, it's self-inducing a panic when that's the last thing you want anybody to do. If you're in the options world and you're a short seller, you got clipped this morning, but the short sellers are the same ones. And when I say short sellers, options traders who sell premium for a living. Generally speaking, their portfolios are delta neutral hedged, even though it's very hard to hedge against a massive 30% move overnight, unless you know how to trade futures. But the point is, it's all quantifiable. And what you're seeing in the market is nothing more than reversion to the mean. Don't panic. If you panic out of this, you will be in a much worse condition because it is the banks themselves that induce the panic. They want to take your money, and they induce the panic, they get your money.
And I want to move on over to how to trade the global crisis. Obviously, the there's a sell-off globally. So I want to get to that. That will be our next video. But Jack, anything you want to kind of talk about, whether it's Kramer or even Intel?
So when it comes to Intel, my takeaway from watching Intel was this is what the whole semiconductor industry looks like without the AI mania, this speculative hype that has reached such obscene proportions. If you take away the AI trade, what you're left with is what Intel just showed us, right? PC sales are down, mobile phone sales are down. Intel has not participated in the AI rally, at least not much. And so if you take away the data center sales from like an Nvidia or an ARM or an AMD or Supermicro, you're left with Intel. And how does that look? So imagine what's happening with Intel, but with the entire sector. Now, what we're seeing today was a spike in volatility, and we saw a partial unwind of the yen carry trade. And guys, you know, the yen carry trade has been years in the making. It's not going to unwind in one morning. So this is not a story that's over. Maybe we recover and we bounce from here, but this will play out over weeks and months, not hours and minutes. The yen carry trade, the short volatility trade, and the AI mania are essentially all the same trade, and the same people are piling into all three, convincing themselves they're diversified. It's all the same thing. When the VIX spikes, the yen carry trade weakens, and so people cover their yen shorts. And when people cover their yen shorts, they sell U.S. risk assets to get the dollars to get the yen. And so all three of these trades that have kind of supported each other higher as people piled into zero DTE options, causing market makers to hedge and bid up the AI stocks. And then they've been going short volatility because, well, when you bid up the AI stocks and you pile in the zero DTE trade, you're also suppressing the VIX. So people started shorting volatility. And people are like, well, I can borrow cheap yen and do both of those other trades. So you pile on the yen carry trade. All three of these big trades that are trillions of dollars large, it's the same people are in all of them. And while they succeeded together for the last 2 years, they're going to fail together also because a change in one affects the other two. So as the VIX spikes, it's causing the yen to unwind and it's causing AI trades to sell off. Or as the yen carry trade unwinds, it's causing the VIX to spike, which is causing those zero DTE puts to go in the money. And now, well, shit, people need to come up with the cash to cover those trades. So it's all one big crowded AF trade. The same people are in all three. And, you know, crowded trades always end the same way eventually with a stampede for the exits. I don't know if we're seeing that right now. Again, the dip buyers came in today a little bit at the open, and it was partially helped by the fact that people couldn't log into their Schwab or Fidelity accounts because all the brokerages went down at market open. So some of the panic selling was absorbed by some strategic outages. But the Intel is the AI trade. Intel is the whole semiconductor sector without the AI trade. And the other thing Intel is trying to do with the fabs, and, you know, they're trying to take a chunk out of Taiwan Semi and bring that manufacturing back here. Much like you don't unwind these trades that took years in a matter of minutes, you also don't walk back decades of outsourcing just because you passed a CHIPS Act. That doesn't mean magically we build factories overnight and it comes back here. It's going to take years for this new foundry trade for Intel to start panning out. So Intel is looking at probably a rough couple of years. I think in the long term, they'll probably come back from this. They're a pretty old company. But also keep in mind, making chips here in the United States, in Texas or Arizona, wherever they're going to do it with American labor, that's going to be more expensive than chips bought in Taiwan or chips bought in China or Japan. So that's going to add to long-term inflationary pressures. See also the earlier discussion about interest rates going the wrong direction. So that's my take.
You know, real quick, I wanted to point out, I want to get you guys, both you guys' opinion here. This is very interesting. It appears that the yield curve inversion is inverting again. We actually are at 10 basis point inversion, which is very interesting considering that we had a period of uninversion this morning. They have changed significantly. Significantly. I'm talking significantly. Now, Mitch, do you suspect there's any type of Fed or Treasury manipulation on the 10-year?
Under the hood, sure, because the banks under the hood can be manipulated by the Fed picking up the phone and JP Morgan, go buy, go sell. So there's enough volume in the big banks to be able to do that. So yes, the answer to the question is sure. Does it really matter? No, because the market will do what it's going to do over a period of time. The real problem is that you've got a situation where we're only back, if you go and look at a chart, we're back to where we were in April in terms of pricing of the market. So market's doing one thing, the interest rates are doing something else. And last week's move on the interest rate on the 10-year in reality was just the market getting in front of the Fed and playing a game of chicken. So nobody knows how it's going to turn out. There's no way to guess that, which is why what's happening in the market is really nothing more than a reversion to the mean. And it's pumped, for lack of a better word. And Intel in reality was a pump and dump. I mean, think of the news that you heard as Intel was climbing all the way into last week. And then all of a sudden, oh, no, it's no good today. Well, what really happened between today and where we were a week or 2 weeks ago? Not much, other than the market moving and saying, yeah, we don't like this anymore. Or somebody woke up and said, yeah, which part of the word artificial in artificial intelligence do you not understand? And that's what happens.
Well done, sir. I want to move on to this next segment on how to play the global sell-off, and then maybe we can go into Japan a little bit. But go ahead and pay attention here, guys. Let me put us on mute real quick, just so there's no echoing. And I really appreciate you both. They're doing an outstanding job. You guys keep your questions, keep your comments coming as well. Definitely appreciate them. But let's move on here to this video. You guys take a listen.
Victoria, there's very few places to hide. You really see the brunt of that bid in the bond market, but gold is down, Bitcoin is down, stocks across every major indexes are down for the most part. How do you position in this environment right now?
Well, what we're hoping is that a lot of people have done what we did with our clients over the past couple of months when we were seeing some of the warning signs that we thought we would see a larger pullback in this market, and start doing that rotation out of the momentum trade, start trimming some of those tech names that you had such high positions in, getting some cash on the sidelines and finding those areas in the market that we thought would do better in a downturn. So we were looking at some of the staples names, some of the healthcare names, utility names. We liked financials, but we said wait for a pullback because financials had such a strong run. And we're starting to see those trades now start to do better on a relative basis. So do you go in today? I'm not sure. I think you take a little bit of a break today with what we're seeing in the market. Let things settle out a little bit and then start looking at some of those names that we mentioned, some of those more defensive, more staple plays in your portfolio, and building those up while trimming some of your other ones.
And Victoria, I do want to talk about what's going on right now, what's going on today, because it feels like we're still in diagnostics mode as to what is actually causing this massive sell-off that we're seeing right now. Of course, there's been a lot of talk about the carry trade unwinding, particularly those yen-funded carry trades. Just walk us through sort of, again, the chain of events there. What is actually fueling this sell-off and where did it start?
There's definitely, I think, a culmination of events that came together at the end of last week. The market is not reacting this way because the non-farm payrolls came in 60,000 less than expected, right? But I think that was kind of the straw that broke the camel's back in the sense that we look at earnings. I know earnings are up 11% year over year, but if you look across the board, you're not getting as strong of a guidance as people were hoping to see. So guidance is concerning regarding consumers. You were seeing yields already start to come down, not because inflation expectations were coming down, but because there were growth concerns coming down. You saw a lot of weakness in manufacturing and a lot of weakness in the labor market besides the payrolls number. You look at job openings, those were stagnating. You looked at quits, those were falling down. One of the most important recession indicators is really looking at the job differentials, job plentiful minus jobs hard to get. It hit a cycle low. So there were a lot of elements churning under the surface that were telling us growth is going to be coming back. Jobs are not there, wages are not there, and that means trouble for the consumer. I think Friday, again, was a culmination of all of that. Add in the unwind of the carry trade that you were seeing as the Bank of Japan raised rates, and the expectation that we would be lowering rates in September after the Fed meeting. All of that coming together, I think the market came to realize, wait a minute, things maybe aren't as good as we thought. Maybe that soft landing is not a given. And that's why we're seeing the reactions we are. We also have geopolitical events going on that adds to the uncertainty.
Yeah. Why do I use the bond?
All right, guys, let's start with, I have to unmute you. I'm so sorry. I think there's someone's echoing. I don't know. So I mute you both. I can't unmute you, Jack, because you know you have the proper etiquette. Mitch, I'm still working with you. And because he has the proper etiquette, I got to go with Jack first. Jack, can you respond maybe and respond however way you want, but to the viewers, how, and it's okay if you don't know, if you don't want to answer this, but how can you play to make money if it's possible? Mitch, don't hurt me because I know you will. All right. I'm not saying buy anything, but how do you play the global stock sell-off? And do you attribute that, Jack, to, the unwinding of, the carry trade, the unwinding of the yen? Can you explain, Japan, what's going on there, brother?
So I would say, without going into specific, what are we seeing? The carry trade unwind, the short vol trade blow up, the AI trade is not doing well. What we're seeing today, if I were to speak very generally, we're seeing a mass deleveraging. People borrowed money to buy risky assets, and today they're getting margin called. And you had Ray Taylor a few minutes ago mention something in the comments. He said the Oracle of Omaha moving to cash, referring to Warren Buffett. And that has been very much my approach for a while now. I mean, I've sat out this move higher in markets. I've been very defensively positioned, but what you're seeing today was a move to cash. You're seeing margin calls. People borrowed money to buy assets, and they're getting a call from the bank saying, you got to pay us back now. And pay attention around 2 o'clock this afternoon also, because that's usually when the margin calls start coming out. I don't know if they're going to wait until 2 o'clock, but the afternoon trading is going to be interesting here. But look, Warren Buffett, one of the most famous investors in history, is sitting on a staggering amount of cash, $277 billion. It was reported last night, up from $189 billion just a few months ago. So Warren Buffett is going to cash. And that's what the whole market is doing right now. Like, what's up today besides nothing? So the market is moving to cash. I'm in my mode right now. I'm about avoiding capital losses. I am not looking to make money. There are ways to make money. And you know what? A skilled trader might be out there messing with the SQQQs or something like that today. Maybe that works, maybe not. But this is about avoiding losses today because everybody is getting wiped out. And what was up? Bonds were up for a little while, but if you look at yields are now, whereas they were down 10 points this morning, so people were piling into bonds for safety. Even that's starting to unwind. The 10-year is only down 4 basis points now. The 2-year may actually go positive here on the yield. So people are selling everything. Even gold was down $50 today. Silver was down 5%. So there's really nothing anybody is really buying here. A little bit of bond buying, but even that's starting to unwind. People are moving to cash. And I think they're moving to cash not because they want to. I think they're moving to cash because they have to. The deleveraging is happening, and it's happening pretty suddenly. The dip buyers came in this morning a little bit. Maybe they're able to take this market back up, maybe not. But, cash seems to be what's on the menu today.
Alrighty, Mitch, anything you want to add to, and we're going to go into another video on the sell-off that's happening right now in America, but you want to get geopolitically here for a minute?
Sure. So everything Jack just said is right. But again, there's more underneath the hood. So that video you played and with Jack, what he just reviewed, in finance, there's something called clustering. So when 3, 4, or 5 items start going down simultaneously, which is what you see, people panic, and that causes the clustering effect. On that video, what you heard that young lady say, well, we're going to rotate out of this entity into this entity. And the problem with such a rotation, that's called churning. If you go from one asset that was a unilateral bet, Intel, to another asset, let's just say utilities, you're taking 2 unilateral bets in either direction, neither one of which is quantified, and neither one of which, in reality, they have sold puts on or created any type of hedge against. And therein lies the problem with a lot of these pension funds like Case Depot or CalPERS or any of them, frankly. If you're taking unilateral bets you bet too big, which is why the margin calls are occurring, and you didn't even have the intelligence to say, I'm going to go and sell some puts, so I'm going to cover off. It'll cost me 4% of my profits this year.
Are you
but I'll be
trading
able,
way less than you
I'll
used
be
to?
able to delta hedge and do the best I can to remain delta neutral on these trades. Had you have done that, you would have come out a huge winner this morning. Your profits would be there, and your losses would have been shrunk. In other words, you'd be net positive. That's what I got.
Well played, sir. Well played. All right, guys, we're going to move on to our next video that's going to kind of go into what's going on right now on the home front. And let me know whether or not, what you guys think of this. A little bit optimistic, more than likely. Let's play this here. I'm going to put everyone on mute. So, don't come out the gate swinging. Let me unmute you first. You guys are doing an exceptional job. And everyone keep commenting. I see everyone. TJ, I see you, TJ. I see you, Davey. I'm ignoring you, though. But thank you for joining us. I really appreciate that. All right, let's get started, guys, right now.
Action right now. Of course, you wake up this morning, you see that everything is selling off. Now it seems like we're taking a little bit of a breath. What's going on?
Sure. I mean, I would separate the price action we saw last Friday, which I would characterize as very much fundamentally driven, versus the price action we saw over the weekend and then to the open today, right? So if you look at like last Friday, what we saw was a broad-based increase in equity volatility across indices, across markets, US, Europe, Asia, on the back of, worse than expected US data and growing fears of recession. Like that's, very well understood and well deserved. And then you look at what happened pre-market today with the VIX, exceeding highs that we haven't seen since the March of 2020, with no change in really any macro fundamental news. Sure, we got, the big sell-off in Japan, but in terms of what has changed for U.S. equity markets over the weekend, nothing. So to me, the price action this morning and today is very much positioning driven. It's very much liquidity driven, whereas the price action we saw on Friday was much more fundamentally justified.
Let's talk about the VIX for a second, Mandy. Shanali pointed out earlier that we've only seen it peak above 60 3 times since the 90s. Here's a one-day chart, and you can see, the moves have been massive. At one point, we were over 65, and now we're under 40. It's still elevated. What is the activity in the VIX telling you?
So last Friday, of course, we're just getting started on the trading day today, so we'll see what the numbers end up being. But last Friday was one of the highest volume days we saw in terms of VIX options, over, I think, 3.5 million contracts traded that day, the highest since Feb 18, which was obviously the big, Volmageddon episode, and higher than any point that we saw during COVID, which I thought was very impressive. But in terms of actual flows, I would say it wasn't all panic buying of hedges. We saw plenty of monetization of existing hedges. This is a theme that we've been highlighting for a while now, for all throughout this year. Even as VIX was kind of hitting really low numbers, we saw record activity in VIX options as investors were kind of playing for that unknown, exactly what we saw over the weekend, right? A liquidity driven or a geopolitical driven event that really spiked volatility. They don't know when it was going to hit, but we definitely saw the buildup in terms of VIX option buying and option activity in the lead up to this event. And on Friday, we saw plenty of monetization of hedges, as well as people playing for a normalization and volatility. What I thought was interesting was actually we saw a bigger increase in volume in VIX puts than we did in VIX calls, which kind of tells you that people are potentially playing for that retracement or normalization and volatility going forward.
All righty, that was a lot there. I want to start, if I can, with Mitch. Mitch, is this a liquidity play? Could you just talk about the liquidity play here, potentially, the self potentially being liquidity driven? And can you tell the viewers, Mitch, are you all in? Are you all out? Are you even in the stock market? Can you give us a little bit of a bone here on what's Mitch doing? How's Mitch surviving this?
Okay, so first of all, what you heard was a bunch of hot air. The reality of it is she's conflating fundamentals with panic. So which came first, the panic or the fundamentals where people are exiting? What she said is just, as Kramer did, completely incoherent. Is it a global sell-off? Yeah. Why? It's small, but the reality of it is, what makes anybody think that what's happening in London or Japan is any different than what's happening here? It's a giant Ponzi scheme. It's all a pump and dump. The banks are behind it. The fundamentals have absolutely nothing to do with it, because you can look at an analysis on a company and say, okay, the PE is X, the debt levels are Y. That's a fundamental study. What you're seeing this morning is just straight up panic, because the market last week, in essence, is playing chicken with the Fed. The market wants the interest rates to go down. That's why they moved the 10-year. And that's what started this. What's going on in Japan and the unwind of the carry trade, if in fact that is the net result, should never have happened in the first place, because the carry trade is another pump and dump. We're going to basically borrow money on a long-term basis using short-term funds. And that combination is lethal. And that's where you have it. So nobody knew what the tipping point was. When I started discussing this stuff with you last week on the fraud, I was jumping up and down on the tax saying these entities are bankrupt. Well, proof's in the pudding, and less than a week later. So in terms of what I'm doing, you know that I'm out of the real estate market. I sold off pretty much everything a year and a half ago. And Jack mentioned Buffett. Well, Buffett's jettisoning because he knows that he can get a higher rate of return with his cash. The second Goldman Sachs or some other big entity calls, i.e. 2008, and says, oh, yeah, I need 5 billion or we're going to be shut down. At which point you would have a massive downswing in a market when a bank of that size calls. So we are exactly where we were in 2008. And again, people shouldn't panic over this, because if you go and look at the chart, it's not horrific in terms of where we are as compared to 60 or 90 days ago. It's just the tip of the iceberg coming unwound, and Jack hit the nail on the head. This is going to play out over months, but those who are positioned not to panic, that have the ability to trade intraday, are going to come out of this smelling like a rose. Everybody else, because the entities that they have invested in, the pension funds, the mortgages, anything of that nature, or you're taking unilateral bets without the ability to even understand what a hedge is or how to put it on, you're going to have some problems here. So, and in terms of what I do in the market, I watch all sorts of things, but I really am looking. I watch NASDAQ, I watch gold like a hawk, I watch oil. So in reality, you sell puts or sell premium. You could be selling calls depending where you are on the futures, rather than getting involved with the unilateral bets. And I like things that are highly, highly liquid. What you saw here this morning answered a question that I've been after to get answered for almost a year and a half, is that what happens to those option short premium sellers, which is basically selling an insurance policy, when the VIX clicks up. It's not the fact that the VIX clicked up, which is what happened this morning, and it clicked up large. That's not what the problem is. What the problem ended up being, which Jack hinted at, is that the brokers ran short of funds, so they locked themselves down because there was a bit of a liquidity crunch prior to the market opening. When the market opened, the guys that showed up were the high-speed, high-frequency traders. And when they showed up, the market started to calm down. But the market was in panic mode because the bid-ask spread was so wide, you literally couldn't get out of your holdings. And therefore, the panic fed upon itself. And the point to all this is, don't panic. You just sit tight for an hour. And had you have sat tight for an hour after the market opened, you'd already have half the losses back.
That's a really solid point, and it's very interesting. I think it was either you or Jack, but you're like, you guys, the 2-year may turn positive. Shortly after he made that comment, the 2-year, one of you guys, I don't remember who, the 2-year turns positive. I want to go into some breaking news on how basically PMI expectations beat expectations with a reading of 51.4. But before I do, anything you want to add to that, Jack, as far as, are you all out of the stock market? What's with this sell-off? I like basically Mitch is if you are playing the market, chill out. Mitch, I already didn't chill out long ago. I already ran out a year and a half ago. People are clowning on me like, oh, you took losses. I was like, man, but if I didn't lose, my stock would be down another 60%. It still hurt. It still hurt losing that money, but I walked away. Jack, what do you got for us, man?
I'm still largely in cash. I've been largely in cash for a while now. And let me just, put the asterisk, guys, that there are much better traders than I out there. So this is not, don't go follow my trades, but I've always been of the impression that losses are far more powerful than gains. So for a long time now, I've been very defensively positioned, mostly in cash and short-term T-bills and money markets, also gold, silver, and Bitcoin. So with the gold, silver, and Bitcoin, I'm taking it on the chin this morning. Bitcoin's getting clobbered because when the margin calls come in, you don't sell what you want to. You sell anything and everything you can. This morning, that includes Bitcoin, gold, and it's increasingly looking like bonds now too, because it looks like there's some selling going on in bonds where initially there was a lot of buying in bonds this morning. The one thing that stuck out at me in that last video segment that you played was she was talking about people trading the VIX, and she said that there was a lot of put buying in the VIX, which means people shorten the VIX on Friday. If people were shorting the VIX on Friday, they are way, way underwater on that trade this morning. I mean, even now the VIX is coming back down, but it's still way higher than it was on Friday. So the margin man cometh this afternoon. The afternoon trading is going to be pretty interesting after 2 o'clock to see what happens there. I don't know. I mean, if the VIX keeps coming down, and gravity always wins with the VIX in the long run eventually just because of the VIX math. So maybe by late afternoon trading, the VIX is back to where we were Friday. But if it's not, the margin calls are coming in and those short vol traders are going to get clobbered.
Okay, let's move on. I got another video prepped up here on PMI services beating expectations. I remember that beating expectations. The last time I remember PMI beating expectations, people will start freaking out about inflation coming back. So I would say PMI is pretty important. Jack, Mitch, go ahead and listen to this for us if you can. Definitely appreciate you. I'm going to go ahead and put you guys on mute real quick. Except you, Jack. I keep forgetting you already put yourself on mute. I appreciate it. If you guys in the comment section, let me know if the audio is okay. We would greatly appreciate that.
Yes, I'll tell you what, look at the markets reversing. Equities moving a bit higher, interest rates moving higher, and here's why. ISM services, all the data here is much better than anticipated. Headline number expected to be around 51. Last month it was under 50, moved back up to 51.4. 51.4, so that reverses the sub 50 read. And if you look at May, we're at 53.8, so at least we're snugging back up over the expansion. If we look at prices paid, well, it's higher than expected, but in this instant, it's not really a good thing. 57.0, expecting 55. Rear view mirror, 56.3. 57 is the hottest since May when it was 58.1. If we look at the services side, this is really interesting. We had 5 sub 50s in a row. This breaks that. 51.1, 46.1 in the rear view mirror, and 46.4 expected. So definitely a surprise here on the employment side. 51.1 is the best level, boy, going all the way back to September of last year, basically a year. And finally, on the new orders front, real jump here from 47.3 to 52.4. We're expecting a sub 50 number. 52.4 is the best since March when it was 54.4. So even though the comps aren't going back super far other than one, what we really garner from this is better than anticipated. And unlike much of the service sector data we've seen, this is more on the positive side. It could have a bit of a lasting effect. Just consider this. Right now, we're at 377 on a 10-year. That's very close to unchanged. At its worst level, it was down 13. Twos at their worst level were down 24 basis points. Right now, they're getting very, very close to unchanged. They're only about down 3 basis points. This is a huge turnaround in interest rates to the upside. David, back to you.
If you're not making
alrighty, let me start with my man Mitch. Mitch, is that an inflation concern? Really, what I'm alluding to here is are you concerned that we're going to have a double round of inflation and they're going to have to pull a double, Volcker and do this whole crap over again? Are you worried about inflation coming back, Mitch?
In certain instruments, inflation will be there. However, in other instruments, you're going to see severe deflation. So you have to separate the baskets of what it is that you're looking at. But for the average investor that's out there, the pump and dump is really the equivalent of you get a dividend. Well, that's great. But if you have a dividend and the dividend yields 2.5%, and you get a day like Friday and a day like today, and your underlying is down 15 or 20%, let's just say for the sake of conversation, it's down 9%. Well, okay, that's great. Now, 2% against 9%, you know how many years it takes to get that 2% of that dividend back? The answer is 7, and everything has to be 100% in your favor. And therein lies the real problem. If the accounts of mom and pop are getting wiped out due to unilateral bets, where the person that made the bet,
big cap technology,
world, et cetera, the person who made that bet is getting a 2 and 20 fee, and they're utilizing pension money to take those unilateral bets. Effectively, you're wiped out. So the due diligence that needs to be done is to find out what the hedges are underneath the entities that you're giving money to. And if you can't do that, then best do not play, because they're utilizing unilateral bets with the public's money.
I'm going to hop into CME FedWatch, see if there's any changes. And as I do that, Jack, can you also respond to that? Are you worried about the PMI expectations? I mean, as crazy as it sounds, right? We're so many on Main Street. We're already hurting. We already feel the recession. I ain't got no inflation in my house, right? But I'm paying for inflation, and everyone's in the economy, or I don't know where I'm paying for this. But Jack, go ahead and knock that out.
Let me just say the ISM Services PMI, that was pretty good. All right. And I'm a doomer, and I'm generally biased to the downside. I'm a pretty negative guy. It's my nuclear training. It makes me see the worst possible outcome in every scenario. So I got to temper that. Say on the surface, that ISM Services PMI was very good. Almost literally every category was in expansion territory. And in a lot of ways, that was the polar opposite of the ISM Manufacturing PMI that we got last week. So that was some good economic data that's going to help to calm the recession jitters a little bit. New orders up, employment up, very good. Business activity trending up. The one thing and the one commonality between both the manufacturing PMI and the services PMI that I saw in the last few days, prices paid rising. They're rising at an accelerating rate. So they're rising, and they're rising faster than they did last month. We keep hearing how inflation is coming down. How inflation is getting better, and inflation is defeated. People are worried about disinflation and deflation now. But both of these PMIs for the last couple of days, both showed the prices paid by the producer, not by the consumer, but by the producer, are rising, and they're rising faster. And then if you go and you look at like Pepsi earnings and Procter & Gamble's earnings and Colgate-Palmolive, all these consumer staple companies that the financial press is telling us to rotate into right now for safety, they're telling us that they've lost pricing power, that when they increase prices now, the consumer can't afford it, so their sales decline when they raise prices. So what happens when a producer, his costs go up and he can't pass those costs on to the consumer? He starts reducing output. And when you reduce output, you start cutting people, you start cutting hours and heads. That means higher unemployment. So what I see on the ISM services today was encouraging, but the one common denominator between services and manufacturing is producer prices rising, and then all the corporate earnings say they can't pass those higher costs on to the consumers. That means lower profits for the S&P 500 companies, and it means higher unemployment down the line. So that's overall, I'd say the ISM services was a positive, but there is definitely some gray clouds to that silver lining there.
Well, I mean, that's what happens when the deficit spending is so out of control like it is. Perhaps want to give a quick shout out to my man right here. Also, Britain is risking a bank run with protests. I mean, the world is melting down, but I got an update on CME FedWatch. Take a look at this. The market has reacted very quickly. Actually, this is crazy because I did a video this morning. Let me actually take us to the left of the screen. CME FedWatch has updated. They're now predicting no likelihood of a 25 basis point rate cut in September. They're basically going all in now. Look at this, Jack. All in, 97.5% likelihood. 50 basis point rate cut in September. Jack, Mitch, take a look at December. Also updating shocking movements here. They're now anticipating it looks like 56.8% of the market is now saying 150 basis point rate cut. Am I looking at 150 or am I looking at 125? I'm sorry, this is 125, 56.8. Again, massive movement in September. I mean, To me, this is signaling the potential that the market is saying they're going to cut sooner rather than later. Let's take a quick look on the markets, and then I want to go into Warren Buffett and get you guys' opinion on Warren Buffett's moves in Apple. But take a look at the Dow right now. Dow's still down 887. It has rebounded slightly. The S&P down 124 points. That has also, I believe, rebounded slightly. NASDAQ obviously rebounding slightly as well at 417. Let's take a look at the VIX. VIX being at 61.44. 10-year sitting at a positive, Jack, Mitch. 10-year has gone. I mean, this is absolutely insane. Like you said, no one's buying anything. The movements here are absolutely shocking. So 10-year went positive. 2 years also positive. Pretty shocking stuff here. Let me cue up Warren Buffett's video right now. And I want to get you guys' opinion on what Warren Buffett's doing. Obviously, Warren Buffett knows a lot. He's got a lot of cash, so it's really interesting to see what he's doing with his cash. So let me go ahead and mute everyone right now, and we'll get this one started.
Hathaway slashing its Apple stake by about half. Tom Forte, Maxim Group senior consumer internet analyst, joins us now. Tom recently raised his price target on Apple to 203 from 195. Keeps a hold rating on the name. Tom, great to have you with us.
Thank you for having me, Melissa.
What do you make of? I mean, some people just say it's just risk management, and it may very well be. But Buffett really has sold well. I mean, he sold, according to the filing, during the big run up in Apple shares, and he also was selling Bank of America, which I know you don't cover, but altogether he's selling pretty well. So how do you take this sort of signal if it is?
Yeah, so I do think it's a signal. So if you look at shares of Apple, they're trading at about a 30 times multiple on the out year from a PE standpoint. And what does success look like on an AI upgrade cycle? Success looks like mid-single digit to high single digit EPS growth. So you're looking at a PEG ratio of 3 to 6 times. So I think the stock's ahead of itself. There's a huge opportunity here for an upgrade cycle for AI. We think it'll be half as big as the 5G upgrade cycle. For example, they're going to have to navigate regulatory challenges in China, which is about 19% of sales, and Europe, which is about 25% of sales. And we already know they're going to do a staggered launch to the extent they're going to have new hardware, or we're going to wait for the new software for the full impact of Apple Intelligence. So Warren Buffett's moves make a lot of sense to me right now.
So in terms of where the stock price is at this moment, 209 or so, do you think that it's pricing in that sort of degraded upgrade cycle or lowered expectations for an AI charged upgrade cycle? You mentioned that you're pricing in about half of what Wall Street is pricing in. In China, it's not just regulatory issues. They don't have an AI offering in China, and they will not unless they probably partner. So it's not just a regulatory issue they have to navigate. It's a whole AI offering that they have to figure out.
They may never have a true Apple Intelligence in China. So they may run into the same issues that Meta and Google have run into in China. So I do think that the market's still ahead of itself. If I'm projecting the 50%, I feel like the market's projecting a full 5G type upgrade cycle, and that may not happen.
At the same time, Tom, relative to other big cap tech stocks, particularly the Mag 7, is Apple, in your view, the most defensive? I mean, it may just be the cash cycle. It may just be, the services revenues. I don't know. That's the way it's being treated, at least in this pullback.
Yeah, from a balance sheet standpoint, it clearly is the most defensive. So Apple has the ability, still generates $100 billion in free cash flow to continue to buy back shares, irregardless of what Warren's doing. And yeah, they're easily the most defensive name in the Mag 7.
You mentioned the multiple. I mean, does that give you pause at this point?
Yes. So when you look at Apple, they just came off 5 consecutive quarters of declining revenue growth. If you unpack their guidance for the September quarter, they're projecting iPhone revenue growth for the first time in a while. And the market is still valuing it at high 20s, low 30s PE. And I think that does give me pause here.
All righty, Mitch, my buddy. And by the way, Mitch, if you have to go, just let us know. I'm going to go for as long as I can make it today, man. There's just such big movements in the market. Mitch, is Apple out of luck? Is their luck run out? What do you make of Warren Buffett's moves?
Warren Buffett is moving money to where he can get a higher yield. The situation with Apple, whether its revenues are maxed out at this point, is to be determined. But the truth of the matter is Warren Buffett is going shopping. That's why he's raising cash. He's looking for the big elephant. and he may already have it in his sights, and I would bet on it.
Okay, I like it. Jack, anything you want to add there as far as Apple, as far as Warren Buffett? A lot of people want to know what Warren Buffett's doing. A lot of data has shown he's pulled a lot of cash. What do you make of that?
Yeah, one of my favorite headlines this morning was Apple shareholders remain calm as Warren Buffett sells out. I'm paraphrasing, but in the entire history of calm down or stay calm or remain calm, has that ever worked? So, you're getting Apple shareholders remain calm. Look, Buffett is selling just like Zuckerberg is selling, just like Bezos is selling, just like Jamie Dimon is selling for the first time in his life this year. He's selling JPM stock. Bill Gates is selling. Jensen Huang and the whole leadership team at Nvidia is selling. The insiders, the big money, has been selling all year. It's been retail who's buying. And historically, when the big money sells and retail buys, we know what happens after events like that. As far as what that analyst just said about Apple, I am 100% on board with what he's saying. The 5 consecutive quarters of declines in Apple's revenue. Apple just reported a decline in iPhone sales yesterday. Apple is losing market share in China. The AI upgrade cycle, look, first of all, I don't know how good or bad this Apple intelligence is going to be. It's an iPhone with ChatGPT on it. Maybe it's good, maybe not. It's probably going to be crap, to be honest with you, because most AI products that have come out so far have been garbage, full-on garbage products. But on top of that, I got to give you the anecdote from Procter & Gamble earnings last week. Procter & Gamble reported that they were seeing declining sales in Charmin toilet paper and Love's diapers, I think is what it was. All right. So they're saying consumers are trading down for generic toilet paper and diapers. So forgive me for being a little crude here, Travis, but if the consumer can't afford to shit, is he going to pay $2,000 for an iPhone with Apple Intelligence in it? I cannot imagine, even if they finance it, even if they offer payment plans, I can't imagine we're going to see people.
What about buy now, pay later?
They might do that, but
buy now, pay later?
Now, pay never is what buy now, pay later is, because I can't back it up, but my personal opinion is the BNPL CEOs are full of it and they're lying about their delinquencies. And I have anecdata from insiders that says that is the truth, that huge quantities of buy now, pay later borrowers are missing payments. And there's just no way these 2.5% delinquency figures they're reporting are accurate. But we don't know because that data doesn't get reported to the credit bureau. So we have no way of seeing it. It's total opacity.
Well said, sir. I mean, look at Mitch, Jack. I mean, you're getting everyone riled up today. I mean, because we've been talking about this a long time, and hopefully the people that have been listening to us are protecting themselves. Big shout out right here again to thank you for the super chat. It means a lot. Let's see if they can get a cap on silver. Any remark right there before I want to go into the market again, a little bit of rebounding, a little bit of movement, but anything you want to, either one of you want to mention about putting a cap on silver? Mitch?
So if you look and study closely the used car market a year ago, an extreme shortage, and now today as a buyer, name your price, extreme devaluation. And that shows the weakness of the consumer. So there are baskets where you have deflation to the nth degree, and then you have other problems in the supply chain, which is causing inflation. So everything's got to be taken in context. And that ties to exactly what Jack was just saying.
All right, let me, we're going to listen to some suits basically here in a second, suggesting that the sell-off today is normal, that everything's fine. But I mean, that shouldn't surprise us. We know how overly optimistic the market is, but let's just take a quick peek at the market, see where we're at right now. You guys can see the Dow, again, kind of just staying around down about 800 points, making a little bit of reboundage right there. S&P now down 125 points. Very interesting. We got NASDAQ down 453 points. Let's see what the VIX is doing. VIX actually up only 55%. I mean, this bad boy went up like an absolute psychopath on a murder spree. This sucker was in some pretty crazy territory, but that again is down to 36.38. So a little bit of reboundage there. Let's look at the 10-year, now unchanged, neither positive or negative. That is just if that doesn't spell manipulation, I don't know what is. I mean, how is that possible? It looks like there's a little bit of positive right there. 2-year also up about 2 basis points. Very interesting. I'm very curious how the market is going to end today. A lot of stuff happening here. Let's go into our next video where Brian Belsky, he's basically at BMO Capital, that is suggesting what's happening right now is normal. So I'm really interested to hear what both Mitch and Jack have to say about the suits continuing to suggest what is going on is normal. So if you guys can, let me know that the audio is okay for this next.
Believe it or not, this is normal, a classic overreaction to macro data, and shouldn't be a surprise. BMO Capital Markets Chief Investment Strategist Brian Belsky, his S&P target 5,600. Brian, why? Our viewers know you've been bullish typically, often right to be bullish. Why do you continue to feel that way?
Well, thanks so much for having us. I think what's going on in the market right now is a microcosm to what's going on in society. We want to react first. It's kind of fire, aim, ready. And I think about the talking heads when they used to say, same as it ever was, same as it ever was. So I have the very good fortune of doing this business for a long time. It's my 35th year. And I remember August of 1990 when Iraq invaded Kuwait. And my boss at the time, William O'Neill, thought we were going into a recession. 6 months later, the market was rallying again. You remember the 90s, David? When I was on your network for the very first time in 97, 98, 99, 2000, 2001, 5 straight years in a row that the month of August was down. People are going to hate to hear this, but this is pretty normal. And it's part of a broader trend that we've talked about now for several months, that the markets in general are heading into normalization. Now, we said 9 months ago in our report for 2024 that the average correction during the second year of a bull market is 9.4%. We've been waiting for this. And so we do not like it when markets go down. We do not like it when people lose money, but this is normal. And I think a lot of investors have been reared through this notion of stocks only go up if interest rates go down. And we're transitioning again to this notion that bad news is bad news. And over the weekend, this is pretty classic. You have a terrible Friday. You have fears exacerbating over the weekend. You have a terrible Asian market. And then you have this rebound here from the lows already here today, Monday. So we're buyers. We're longer-term investors.
What are you, all right, Brian, what are you buyers of? I asked that question because, of course, even previous to this recent downturn, we saw this significant rotation out of the mega cap names, for example, that had been a key store of significant outperformance for some period of time. So, what do you advise people to buy?
So from a positioning standpoint, our theme has been own a little bit of everything this year, meaning we've been provided a gift of this oversold nature for the last 10 years of small mid-cap stocks. I think from a fundamental perspective, they're the best position assets for the next 10 years. Value stocks again, and own some what we like to call the consumer staples tech. You've been provided a gift here the last couple of days in terms of your Amazons, Apples, Googles, Microsoft.
Melody, I see you.
Apple. You absolutely positively have to have exposure to these names. Now, these names obviously got too cocky on the upside with respect to their valuations, and now they've been humbled. Everybody needs a little humility in their life, and we've seen that in these names. We believe that is short-term and reactionary to be chasing consumer staples and utilities now, because especially consumer staples, David, these are very, very expensive names. If you do a relative PEG ratio compared to technology, they're not earning on an absolute basis what technology is. So let's take a step back. Christmas comes early, and Christmas is today, and we should be positioning accordingly for the next 3 to 5 years, which benefit U.S. and North American names, and you've got a great opportunity right now.
How much should good car insurance cost you a month? $80?
That commercial wasn't annoying, so
$120?
don't worry about that. I'm going to take you guys off mute when I catch up here. Look at who decided, look at who decided to show up. Melody, right? See, I get choked up. People gonna clown on me if I keep, all right, I'm going to get myself out of this hole. Melody, how are you?
I'm great, Trav. How are you?
I'm good. I know you you may have missed that. Maybe I can ask you the first question. I was going to go to Mitch, but can you just Melody's made me cry before, Mitch. Jack. She's made me cry, and I specifically asked her not to, and she kept at it, and she made me cry, and you know it, and I told you not to do that. And I
Whatever.
was so mad. All right, sister, whatever. But anyways, so back to emotions. Can you explain to the viewers, Melody, like just how freaking emotional all this freaking mess is, and can you go into just it's really about expectations, confidence, trust? Well, and now it's also about losing money in reality. Can you just knock that one out, Melody?
Well, I would say I don't know if Jack has spoken yet, but he would be perfect for this question. I can certainly give it a try if you'd like, but I mean, this is a confidence game, 100%. And so what you're seeing right now is what Jack and Travis and I have been trying to show you is the underlying weakness that is there, such that when confidence gets shaken,
Let's get to
the
Diana.
risks that are out there. So, you know, that ultimately is what we're trying to prepare you for. And today is a good example of where emotions are taking over. And people are going to be making a lot of rash decisions when they can, when the platforms are up. That's something else we can talk about. But guys, the fundamentals do matter. I know that for the longest time it didn't seem like they did, but if there is no consumer, if the consumer can no longer spend, buy stocks, or do things like that, then that's our economy is 70% consumption. And so what we have been trying to show you is that consumer is in one of the worst spots that they've been in, maybe even in our lifetimes. So, Trav, not exactly sure what you were looking for, but basically, today is just a culmination of a lot of emotions that we've seen play out over the last several years, but they're going in the wrong direction today.
I was looking for your honest. Go ahead.
Or the opposite direction, I should say.
I was looking for your honesty, and I certainly got it. And you guys don't forget to go to Melody Wright's Substack. We are not rich people. That's all I'm going to say. I was going to say I'm barely hanging on. Okay, I'm not like Jack and Mitch. Look at Jack up there. Look at his shirt. I mean, I got a suit on. I'm trying to be like Mitch. Anyways, Mitch, can you talk about how emotional I am? I mean, how emotional the markets are?
I really can't help you. You're beyond help. But aside from that, you have to stand back and look at what the banks do. So if you go and study a chart closely, it doesn't matter. You pick a chart, doesn't matter. But you'll see that the market moves up intraday or whatever, daily, weekly, and pulls back. Well, if you get a big pullback, a big down dip, you individually can't move the market. But that big down dip can be moved by a handful of banks. So they're inducing you to go short. And that's why when traders enter a market on a down bar, all of a sudden they get their head ripped off because the next bar is an up bar. Well, that's the job of the banks. And if you don't understand that as an investor or a trader, you're the pawn. The bank's job is to take your money. They're a trader. If the bank is in the business of trading, their job is to take your money. So they induce you to move. Well, when you had a liquidity crunch this morning, just prior to the open, before the high frequency traders stepped in, you had a liquidity crunch and you had a legitimate panic going on there. Thank goodness that the high frequency traders stepped in to add the liquidity to the market. But who caused the lack of liquidity? Who caused the market to go down? The individual traders? No, the retail traders are a small portion of this. These are the footprints of the big banks. And you just simply have to understand where you are on the charts. And that's why I said when we started the show, don't panic. And all of a sudden you're seeing the net results. If you had panicked out on a double dip, right about now, your head would be ripped off. So you got clipped on the way down, you got out because you panicked, and then the market went up, which means you just got clipped on the way up. Panicking doesn't do anybody any good.
Well, I wish I would have known that before I sold my stocks. That was a great answer, Mitch. That was a great answer. You guys, we got a lot to cover. I got a new video on mortgage rates coming out. I personally don't think mortgage rates are going to help. I got a comment for you here, Mitch, from JJ Watt, the player. That's what's up. That's how famous we're getting. That's how many people we're hating. JJ, thank you for everything you've done for Houston. I'm not a fan because of the kneeling in the national anthem, but JJ Watt, thank you, brother. Only $4.99. Mitch, I'm just kidding. You're not the real JJ Watt. Thank you so much. Jack almost fell out of his seat. Mitch's thoughts on Moore versus USA Supreme Court ruled that the government can now, this is hard for me. This makes me so upset. What are your thoughts on now the government now being able to tax unrealized gains, Mitch?
Okay, I'm extraordinarily familiar with that because I'm wondering if JJ actually read my amicus brief. So that case, it was an unrealized gain from an offshore investment, not onshore. There's a big difference. So onshore, under the 16th Amendment of the Constitution of the United States, it is illegal to tax what is an unrealized gain, which in fact is the definition of a market value. So market value is in fact an unrealized gain. And in the cases that we've got rolling forward right now on my website, you'll see the amicus brief that outlines that exact issue. And that was even tied to Chevron deference, which was government overreach. So if you read the brief, thank you. If you're wondering what had happened there, that's the net result. Charles Moore was the gentleman's name, and his wife got hit and were charged on a tax for an unrealized gain off of a foreign jurisdiction investment. They did not win the case. However, it has nothing to do with you or I or anybody in the United States of America under the 16th Amendment to the Constitution being charged a tax. So what you're seeing at these CADs, i.e. in the state of Texas, where the state of Texas says, well, you pay tax based on market value. In truth, the state of Texas has done an end run around the US Constitution. And that's why in one of the videos that Jack did a few days ago, I said, there's a high probability that we will be heading to the Supreme Court of the United States of America over that exact issue.
Mitch, this wasn't directed towards you, but I'm pretty sure that's your Discord in the background, Mitch. I'm not sure on that. I'm not trying to call you out. Another thank you to our friend here. They already are when it combines, oh my gosh, property. Don't get Mitch and I started on property tax and inflation and the lack of income calculation. You guys, just real quick, shameless plug. I want to get to you, Jack, who's been silent. I know it's killing you because Melody, you missed Jack. Oh my God. But anyways, Mitch and I just did another whistleblower video of someone that came forward regarding 313 agreements and how the school districts are freaking bankrupt. The pension holders are insolvent. So we got that one. I still got to put together. I'm going to go over the market here. But first, Jack, anything you wanted to add to how emotional I am? I mean, the market is, geez, man, I just can't get that right.
Just give everybody a glimpse behind the scenes. Travis is a hugger. I don't know if you guys know. When we hang out and, you know, we have a couple of drinks, Travis is one of those guys who's giving everybody hugs by the end of the night. So he is a big dumb animal, isn't he, folks? But we love him. Travis, you're awesome. You're emotional, but that's just fine. Look, on the subject of the unrealized gains tax, what is a tax on unrealized gains? It is wealth confiscation. That's what it is. It's just the government saying you have too much stuff and we're taking it. And the income tax is bad enough. They tax everything. There's a reason why the socialists are in favor of it, of taxing unrealized gains, because socialists just love redistributing wealth in their own direction. And that's about all I got to say about that.
All right. We got some breaking news, actually. Melody, do you want to share your screen? Can you give us an update on what's going on?
I'm just going to tell you. But but guys, here's the other thing to be looking out for today. And as Travis kind of asked me as I just got on about emotions and things like that, also realize that activities or things that happen like we're seeing today can also be a smokescreen about other things. And so be looking for those stories that also come out today that otherwise would be big news, but today not so much. So thanks to my buddy Julius Miami, I often call him my sourcer. He just sent me a note that the CFPB is investigating Chase regarding Zelle fraud. And so essentially this is, they're evaluating next steps, including litigation. And so again, this is if people aren't familiar, Zelle is kind of their wire transfer cash payment system. And so there's a lot going on, but also, we want to keep everybody's eyes on if there has been fraud and other things in the system. Obviously, we have Mitch with us here today. So
Yeah, I have that right here. The Zelle controversy heats up. JP Morgan considers legal action. I mean, holy smokes. Chase is a pretty big company. I'm going to give the viewers a real quick market update, see where we're at as far as the crashing of the market. So the Dow, let's see, kind of just staying stuck down about 800 points, 868 points. It's about almost noon Eastern time. S&P down 130 points. NASDAQ down a little bit sharper at 491. So little tiny bit of rebounding, not much. Now, again, the yields are absolutely all over the place. European stocks closed 2.2% lower amid a global downturn as volatility index spikes. Reversing again on the 10-year, very interesting. Let's see the 2-year. 2-year still up almost 2 basis points, not quite. Let's look at the VIX, guys. VIX is... Man, I cannot believe how much this is lost. I mean, it's absolutely unbelievable, the movement in the VIX. I mean, it was at, I don't know, Melody knows because we are in the group chat together. This is at $65. So, man, that pre-market fear, unbelievable. A lot of rebounding in the Bitcoin, only down 7.68%. What I want to do, guys, is let's move on to mortgage rates. We're going to listen to a video on mortgage rates, and I'd really like to get you guys' opinion on whether or not you think lower mortgage rates will even make a difference in the housing market. So we'll listen to that right now. If you guys can, please let me know that the audio is okay. And again, Mitch, if you have to go, buddy, just let us know. We definitely appreciate your time. We know how busy you are, brother. So just let us know in the private
if you
chat.
want me gone, just hit the button and I'm gone.
I do not, brother. We appreciate your time. Let's get started on the video right now, okay? All right, guys, let me know the audio is okay.
Oleg with the very latest here. A lot of people are watching this very closely and cheering the decline we're seeing.
The one thing they're cheering today, right, Melissa? Look, rates are falling hard and fast. They came down all of last week, most sharply on Friday, and they will likely be even lower today. Last week, the average on the 30-year fix went from 6.81% Monday to 6.4% by Friday. That's the lowest level since early May of 2023. The recent high was 7.52% in late April, and home sales have been falling ever since. Buyers were battling not just high interest rates, but also high home prices and a lack of supply. Supply has improved a little, but prices are still overheated. But take a look at the difference. In just a few months, it is stark when it comes to affordability. In April, a buyer looking to buy a $400,000 home with a 20% down payment and a 30-year fixed mortgage would have been facing a monthly payment of $2,240, not including insurance and property taxes. Today, that payment, $2,000. Now, more buyers would also qualify for the loan at today's lower rates. An even bigger impact is on the refinance market. At today's rate, well more than twice as many borrowers can now benefit from a refi compared with 1 year ago. The vast majority of borrowers today do have loans with rates well below 5%. But for those who may have bought a home in the last 2 years, this is an opportunity. Homeowners are sitting on a record amount of equity, but cash out refinancing has not gained much over the past year. Melissa?
How do you think the decline in mortgage rates balances out with the fears of recession, Diana? I mean, the reason why mortgage rates are falling is because people are worried about what's going to happen with the economy. And the decline in the stock market obviously impacts how people feel about their wealth, their situation.
Right. I mean, you would think that, like, I look at the builders today, you would think they might be less bad than some of the other stocks. But really, if you look at this as being your single largest investment, yes, mortgage rates have come down a bit. But if you're worried about the economy, you might be worried about your job, you're worried about your future, you're not going to want to take that step, especially if you're the first time buyer. But I think if we start to see rates more in the 5% range, that might kickstart a couple of people.
You guys, we're already, we're already in the 5% mortgage range, just so everyone knows that, despite what you're saying. And actually, for new home construction, we've been under 5% for, a pretty good time here. Let me see. I don't know if Johnny's going to come online, but I wanted to get your opinion. If I could start with Melody. Melody's had her pulse to the housing market like crazy, and also to consumers, because we are one, huh, Melody? We got another super chat. I'll get there in a minute. But Melody, can you go in to the wealth effect? I specifically want to talk about the wealth effect when it comes to owning a home and how that's. What do you think about the wealth effect?
Well, I think it's, I think it's probably another sort of failed understanding of economics. But essentially, the idea is that, you feel wealthier when your home increases in value, and therefore you're going to spend more, is the general idea. The problem is that whole idea doesn't take into consideration the fact that when your house goes up in value, so do your expenses, your property taxes, your insurance, your home, your cost to maintain the home. So in reality, I think that this is just yet another one of those myths out there that economists like to tout, but in reality, it does not do anything for Main Street or the consumer.
Mitch, can we move on over to you, man? I mean, do you think a drop in mortgage interest rates will, say they drop 100 basis points, okay? Their average interest rate, 5.75. Do you think that's enough drop to sustain home prices?
No. In
Why?
fact, because the reality of the situation is, and we've got the math that's on our website, 37% of the households, and that's multifamily tenants and that's single family property owners, cannot afford the roof over their head. They're going to lose the house that they're in or the home that they're in, and or they're going to go bankrupt. If you tax people out of the roof that's over their head, the clear answer is no. There's no amount of money on this planet that's going to force them to go get another house. In fact, the people that are in houses are going to end up in multifamily because everybody's got to live somewhere. Well, that's the tipping point. So you could drop interest rates 2%. There are some people that it will help, but the reality is even those people that you think it will help, well, they're all subject to now what you're looking at is hyperinflation of construction costs, even though it's somewhat leveled out. But when you're being taxed, a real estate tax, on an inflated number on top of the fraudulent number that the CADs created, the answer is no. It's a pump and dump scheme.
You Take My Breath Away. I almost sang that You Take My Breath Away song. Is that by Whitney Houston? I can't remember who that's by. I just want to give a shameless plug real quick, okay, you guys? If you have a free second, if you're watching this video, just for your boys, just for the Duma crew, go to Melody's Substack, okay? I'm not joking. Go to her Substack. Here it is. Melody didn't know I was going to do this. I'm sorry if I'm embarrassing you, Melody, but I don't care. Support us, guys. Here's her Substack. Pay for the subscription. This is how we travel around the nation. Notice we haven't been traveling around the nation. Everyone's feeling the recession. And when you're done at Substack, please don't forget to go to Nobody Special Finance. This is our buddy, Jack. Jack, you have helped our community in Real Estate Mindset grow like crazy. I really appreciate you. Again, you guys, don't forget to go there. Now, shameless plug, sorry about that. But Jack, can you kind of, sum up what you believe is going on with mortgage rates? Will the mortgage rates going down, say 100 basis points, even 50 basis points, be enough to sustain this level of unaffordability, and maybe even talk into the wealth effect?
So I don't think it's going to have that much input to unaffordable. I think people already can't afford it. And I don't think a few basis points is going to really change that dynamic. And also, let me throw the asterisk. When it comes to housing and this crew, you guys have more of a background than I do. Now, the one thing I would caveat with, one thing that has definitely reacted in the last few months, every time we've seen a step down in interest rates, we've seen the refi index step up. So I don't think this fall in prices is going to affect, or I'm sorry, I don't think this fall in interest rates is going to affect home prices. I don't think it's going to affect transactions, new or existing, but I do think we will see a surge of refinancing. And what we're seeing with these refis is not necessarily a good thing because people are refining from a low rate into a higher rate, right? Most people refied years ago. Most people are sitting 2.5%, 3.5% mortgages right now. So if somebody does a refi right now, why are they doing that? They're doing it so they can cash out that refi and use that cash to pay down more expensive consumer debt like credit cards, which are now at obscenely high balances and interest rates. So the spike in refis that I think is going to follow this decline in interest rates is going to result in some consumer debt being paid off, which is a good thing. But the problem is most people are not making the necessary adjustments to their lifestyle. So as soon as they pay off that consumer debt, they immediately start racking up new consumer debt, but they have the higher mortgage that they have to pay every month. So I think ultimately it's going to make the long-term pain worse because people are going to come out of this with a refi into a higher mortgage with a bigger balance. And eventually they're just going to run those credit cards right back up anyway. So maybe a little bit of a delaying of the consumer recession caused by the refis. as people get at least a momentary reprieve, but long term, it makes the pain worse.
Okie dokie. Speaking of refinance, since we're on this subject, I want to remind any viewer that's listening right now how bad a refinance can actually be. A lot of people are like, oh, if it goes down 1%, I should automatically refinance. That is so false. And a lot of people, honestly, Jack, Melody knows this too. If they're refinancing, say from a 7 to a 6.5, again, that's usually not good enough. But a lot of times these people are sold because they get a refund on their escrow, okay, which is their property taxes and insurance. So make sure if you really are refinancing, that there's a true benefit, because again, on the screen, if you guys refinance, you start the amortization schedule all over again. When we take a loan amount of $324,000, even at a 6% interest rate, your total interest is the same amount as your loan. It's higher than your loan. So the interest is over 100%. That's the point I'm trying to make. It's not just a slam dunk refinancing. I hope the viewers understand that. So don't get lost in that narrative. Are we ignoring the padded jobs report, part-time gain, government position gain, full-time loss, and adjusting previous reports? Melody, do you want to talk about this comment? I'm going to queue up another video. I have a video here from JP Morgan, Jason Hunter, basically saying that there's no tactical bottom yet. So at least they're being honest. But do you want to go into this a little bit, Melody?
Well, I'll just say that I think that we talked about this on DNN very specifically last weekend when we said, there's not just one thing going on in the market. There are several things. And, be cognizant of that when you see these headlines coming. There's always more than the headline. And so we're certainly here. This crew is not ignoring that report. But, and honestly, if you read mainstream media, they were attributing a lot of the action last week to that jobs report on Friday. But in reality, I think you probably saw more movements from the reversal of the Japanese, the carry trade with Japan, the Japanese yen. So no, we should not be ignoring this. We should not be ignoring the fact that we don't feel that we are getting the correct numbers in any of these reports. We don't feel like we truly are, we feel like we're being gaslit. And so none of us should be ignoring it. And I think that what's happening in the markets today that's shaking confidence is a plethora of things. It's not just one thing.
Mitch, do you want to go into good job? Thank you, Melody. Do you want to go into the job numbers, the fact that we're losing part-time jobs? I'm sorry, we're gaining part-time jobs as of right now. We're losing full-time jobs, the seasonal jobs. You want to go into those job numbers, buddy? And how? Oh, and also, Mitch, let the viewers know what the real unemployment rate is.
That's actually where I was going to head automatically, because the jobs report is just complete nonsense. First of all, if you said, well, our jobs report is showing 3.41% unemployment on a gross number basis, yeah, that's about 300% off the mark. And it's real simple to get there. You look at the illegal migrant problem. Those people don't have jobs. So if you simply say, okay, fine, you can debate the number. It could be 15 million, 20 million, 22 million. You pick the number. Do you understand that the cost of 20 million people without a job is over $1 trillion a year? We ran the math. If you take that 20 million number, right now today, your real unemployment number in the United States is well north of 10.8%. So the idea that, well, we have a basket of people moving in and moving out doesn't take into account the real unemployment number from the illegal migration problem. It doesn't take into account the amount of people that actually have 3 jobs. It doesn't take into account the amount of people that actually have 2 jobs. They're cross-contaminating any notion of legitimacy whatsoever by trying to gross up a story. It's another pump and dump. They're just going to try and pump it up. And then the market 60 or 90 days later will say, oh, well, we have to have a revision. They're so far off the mark. They're 300% off the mark. So you're starting at ground zero. You're starting with a straight up lie.
Travis, if I could weigh in on that also, because Mitch, you're 100% right. And it has been so painfully obvious for years, because since the start of this messed up decade, we have seen inflation that has been tremendous, and we have seen wages severely lagging the inflation. So the cost of goods and services, the cost of life, has gone up so much more than the cost of labor, than the cost of wages. All the while, we have been told the job market is so tight, that there's a shortage of labor, and unemployment is so low. Simple supply and demand proves that that has been a BS talking point all along. If labor supply was really tight, then labor would not have been getting cheaper relative to everything else. Labor would have been getting more expensive relative to everything else, but that wasn't happening. Everything else was getting more expensive relative to labor, which means simple supply and demand proves that this tight jobs market has been a BS talking point the whole freaking time. And in that last jobs report that we just got, if you go and look at table A7 of that jobs report, there are two statistics: the number of employed foreign-born people in the United States, which includes both legal immigrants and illegal immigrants and some U.S. citizens, right? Some U.S. citizens are foreign-born, so it's not a perfect example. But we had 1.25 million more foreign-born people working in this country, and we had 1.25 million fewer native-born people working in this country year over year in the last jobs report, which means the people they are importing are almost 1-for-1 displacing native-born American citizens from the job market. And that is why the cost of living is rising faster than the cost of wages. It is a manufactured, artificial supply of labor, and all the while they're gaslighting us, telling us the job market is so good, it is bunk. That's all I got.
Okay, Melody, I don't know what's got into Jack this morning. Mitch, normally Jack's not like this. Absolutely, no. He's like this. We got a super chat here. This is a very interesting question, and we appreciate the support, Big Kid. How likely will home prices drop? It seems whenever interest rates drop, it's a feeding frenzy, and people are bidding way over asking price. Now, the first thing is I want to kind of answer this a little bit. I have to acknowledge it's about market. It's about local data going into the subdivision. So you really got to go into subdivision if you really want to know what's going on and you really want to compare what's going on. So first of all, we got to go into subdivision. And then the second thing is prices are already dropping on a nationwide level. The third thing is some housing markets are in bad shape as far as prices, but other housing markets, Santa Ana, places in San Diego, even East Coast, some of those markets are still tight, and they are actually going up from a median sales price standpoint. So we have to acknowledge that. But what I want to say to Big Kid is when we look at the data, and I'm referencing Redfin's most recent housing market update, when we look at the data, we see when we compare year over year that interest rates are lower by 20. The last report was 26 basis points. So now we have year over year data comparing where we're at with interest rates and where we are at with demand. So first of all, we need the next report because interest rates have been plummeting. So this report I'm looking at is not even counting the recent drop in interest rates. So there could be an increase in purchasing demand, but I don't think there's going to be enough increase in purchasing demand to sustain the value. And again, going back to the report, 26 basis points year over year decline, yet demand is down 14%. Interest on the internet is down 19%. So again, interest rates are lower, yet demand is down double digits. Do you want to add anything there, maybe, Melody? It's a little bit of a complicated answer, obviously.
Yeah, I just would be careful about, so I agree with Travis, and, real estate is local and it's important to know your local market, but the realtors and everyone in those markets have, their vested interest is in making you think that FOMO is starting again. And let's take Dallas, for example. I remember very clearly about 45 to 60 days ago, everybody talking about the fact that Dallas was heating up again with, people offering over asking and all of this nonsense. In reality, there were a couple different neighborhoods, and I've heard even in those neighborhoods, we're seeing more and more signs go up for sale, but we've seen year over year prices drop in Dallas. And so just be wary, ask those realtors, can you see the offers? I mean, Travis will tell you they could say anything they want to, right? They're not supposed to, but they will say what they want to get, the highest commission possible. And so not Travis, of course, and not other really great ones that I know, but This is important that you don't fall for the FOMO again, because what Travis is saying is absolutely true, that rates are actually lower year over year. The other things, guys, we just hit the lowest number of absolute sales, lower than 2008 for June, which is the high season in housing. And so seasonally, we just broke that. We broke the seasonality because sales were so unbelievably low. And that is with population increases that we've had since that time period. So the consumer is broken. I've talked about that in terms of the mortgage delinquency. This is not going to spur some recovery in housing. What's happening right now is you had a market that was completely divorced from fundamentals, and you have a consumer that is completely broken. And if you're in the top 10%, guess what? You're going to be impacted by what happened today, or like Jack and all of us have been trying to tell you, you've already pulled your money out and you're going to go hide on some Caribbean island for a little while.
Boom. Hold up, guys. Hold up, guys. Mitch, you look motivated. Jack was motivated. Let's do a quick market update. I got to go into Jason Hunter at JP Morgan Chase, essentially saying that this may not be the bottom. It may not actually not be time to buy, but take a look at the rebounding in the market. I mean, the market is trying desperately to cover up the massive lack of fundamentals here. Take a look at this rebound, guys. The 10-year is up 22 basis points. Huge shocker, because this was down. This was down, I think it got to 20 near or 18 basis points. It's now up 2 basis points. Massive swinging there. Selling going on in the 10-year. Take a look at the same thing with the 2-year. Selling going on with the 2-year as well. Just really shocking, about what is that, about 12 to 13 basis point inverted. I mean, we were so close to uninversion. That gap has now distanced itself once again. It looks like, again, 12 basis point inverted. Just really shocking movement here. VIX, lot of momentum lost in VIX. You may, if you're just joining us, you may say, what do you mean 45% up? This thing was up to $62. So the VIX is losing some of the steam. Bitcoin is rebounding slightly, staying stuck about down 7%. Now the Dow is trying desperately to get under a loss of 80 points. It's down, looks like it's almost over 80 again, but down 797 points. S&P still down 119 points. NASDAQ still down 455 points. A lot of massive movement here. Let's listen to Jason Hunter at JP Morgan Chase. And if you guys can, let me know that the audio is okay. I'm going to go ahead and mute Mitch here and myself, and we'll get this one started. If you guys can, and the viewers, keep commenting and let us know that the audio is okay. And let's listen to what they have to say.
Next guest saying the NASDAQ 100 already hit his downside target zone, but shows no signs of a tactical bottom yet. Joining us now, JP Morgan's head of technical strategy, Jason Hunter. What does that mean, Jason? No signs of a tactical bottom?
Well, I guess there's a short term, and then there's the bigger picture that we'll have to discuss after, because that's important. On a near-term basis, when you see these type of washout events, the VIX north of 35, you normally look for a handful of things to identify that tactical bottom. One of which is trend deceleration on the high-frequency charts, where moves very rarely end with peak momentum. You'll get an element of deceleration, base building, and within that, you see a bit of leadership rotation. Normally, small caps will start outperforming large caps in that environment. And again, I mean, look, it's only been 2 days of really aggressive downside movement here. It's going to take a little bit for that to set up, but that's what we'd be looking for right now to identify a tactical low.
And longer term, since you mentioned it?
Yeah, so the longer term is this the beginning of something bigger? And we think there's enough evidence in the lower frequency, bigger picture charts and cross market setup that suggests, yes, this could be it. Number one, 3-month, 5-year curve has been inverted for 20 months plus now. That's well within the window of time between curve inversion and equity market peak and cycles going back to the 1960s. Additionally, we've seen the risk off elsewhere. Dollar yen was already mentioned. Curve bull steepening and breaking out in many cases of multi-year base patterns. And most importantly, what's been missing up until this point, a number of those things could have been said, certainly from summer of last year through now, but now the bond equity correlation has flipped. Where bad news is bad news in a sense. The idea that the Fed may be easing sooner than the market had anticipated, the equity market isn't taking that as welcome news and staying under pressure. So, in a sense that we could see a tactical low here until proven otherwise, I'm operating under the assumption that that will be a bounce within a broader bear trend, and I'd look for it to fall, even shy of the gap we had from payrolls just on Friday.
For a lot of people, Jason, a lot of people are trying to figure out whether or not the whole trade has been deleveraged in terms of short yen along risk assets like the Mag 7, for instance. And so when looking at the NASDAQ 100, or even maybe more specifically the Mag 7, how good of an inverse correlation is yen versus this group of stocks?
Well, it's been tight, and the Nikkei's been there as well, and the Nikkei's already been hit down well more than 20% here. And again, I think the important thing is, like, if that unwind is going to continue, the idea that watch the nature of the bounces. If they're corrective, do they fail at things like the payrolls gap that we had on Friday? That's what we'll be watching next after we try and navigate a tactical bounce here.
All right, let me go to Mitch. We got some breaking news as well. I want to go to Jack here in a second. Actually, pretty crazy stuff. I'll bring that article up here in a second, Jack. Mitch, can I get your opinion on a tactical bottom, if you will, the way he was explaining a tactical bottom, and when you think it may be a better time to buy, perhaps?
Well, it's a function of what it is that you're buying. But the reality is, as I mentioned before, we hit a double bottom this morning, but this is on a short-term basis. In other words, they can yip yap all they want, but this is a trader's market. This isn't a market for mom and pop to be investing and say, oh, I'm going to go long, if you don't have the ability to trade around what you went long. If you decide today, because IBM is down, and you say, I want to go long IBM, if you don't have the ability to sell puts against that position and or hedge it with a further out of the date put option, best do not be trading this, because you will get run over. And people lose sight. I keep coming back to that 37%. If mom and pop have a decision to make about what food to put on the table and or pay the real estate tax and or pay the rent this month, you clearly have a problem that's underlying all of this that the mainstream media is completely clueless about. And therein lies the truth. So mainstream media, pump and dump, and mom and pop, their incomes, roof over their head, are going in the exact opposite direction. So the market will do what it does. Eventually, it's going to reach a mean, and that mean will be down. It'll be down in terms of price to earnings ratios. It'll be down in all sorts of stuff. Nobody can quantify the exact timing of that. Nobody is Nostradamus, but the reality is it's going to happen one form or another. What you're seeing today is just frankly, a good up move, which indicates that, yeah, there may be some stability in the market, but it doesn't take away from what's going on under the hood in the condition of mom and pop.
We got some really good videos that just came out. I know Melody is going to be interested. We got Mark Zandi just coming out saying how resilient how resilient the economy is.
Travis,
And then
I
another.
don't need to go to jail today. Okay, I really don't.
It's about the entertainment.
I've got
and then we have
got responsibilities.
All right, fine. And then we have another video
I'm
to
just
go
kidding.
in. I know you are. We have another video on how the market's down roughly $1 trillion. So we'll listen to that. But before I do, we have some other breaking news that I was going to say for Jack to go over. But Jack, I am not subscribed to PC Magazine. Do you want to go over that story? Do you want to share your screen? But some pretty major news.
Okay, hang on a second, Trav. Let me share my screen with you here, because I have it open here.
Now, as he's doing that, Melody, do we want to hear the video from Mark Zandi, or do we want to talk about the 1 trillion in losses over the last week?
We could do the 1 trillion in losses first.
Okay, you're
maybe.
not a Zandi fan. What's going on here, Jack?
All right, so this story got buried in the chaos of this weekend, but this is potentially huge when it comes to the NASDAQ and the S&P 500. Nvidia's Blackwell AI chips reportedly delayed by months. Now, for the last few years, obviously the AI trade has been a very big deal. The H100 has been the GPU that Nvidia has been selling like hotcakes. And the Blackwell line of chips is their next generation that's supposed to be even better than the H100. Much better, right? And Jensen Huang has already sold tens of billions of these Blackwell chips to Microsoft, Google, and Meta. Each have bought tens of billions of these. So already sold. That's important. Now we're hearing from this article in PC Magazine, it was originally reported in the information that the Blackwell chip has been delayed for several months due to a design flaw that was identified late in the production process. In other words, the thing doesn't work, all right? And they have already started mass producing it. Now, there's very scant details about this, maybe a firmware patch or something, and it works. All right. But just on July 29th, which was what, a week ago, not even a week ago, on July 29th, Jensen Huang was at this SIGGRAPH conference, and he told everybody at this conference that the Blackwell chip was coming along swimmingly and that samples were being sent out and that as early as this month, these things are going to start shipping. And just a week later, we find out about design flaws identified late in the production process. I just got to mention, guys, I have been getting the creeps from Jensen Huang for years because of that stupid motorcycle jacket that I can't help but think of Elizabeth Holmes and the black turtleneck at Theranos while that was going on this whole time. And now here we've got a product that they have already sold, already mass produced. And a week ago, they told us it was ready to ship. And now we're finding out, whoops, there's a design flaw. And this is the one stock that is single-handedly propping up the entirety of the freaking stock market. And their next big thing doesn't work. All right. And I had an angry piece of fruit tell me this was fake news right before he started threatening me and saying I should be stoned alive in public. But this looks like this is a real story. Nvidia is saying, oh, production is moving according to schedule. They're not commenting yay or nay on this story. But this could be a huge freaking deal, because if Nvidia comes out in 3 weeks and says there's a problem, then what we saw this morning is going to seem like a walk in the park. So if we're trying to talk about an Nvidia bottom, this story has to come up. And this the press just missed it because there was so much other news this weekend. But that's potentially huge.
What do you think of my buddy Mitch? What do you think of Jack? He's pretty good, huh?
Everything he just said can be summed up in 2 words: pump and dump. That's exactly what it was.
That's 3 words technically at the end. Well, unless it's a letter.
Yeah.
Okay. Okay. You guys, we're going to move on to a video real quick on the $1 trillion. Again, $1 trillion in losses. Oh, wait a minute. You hijacked the stream there. $1 trillion in losses. If you guys can, let me know that the video audio is okay.
The Nasdaq down almost 3% today, down more than 10% from its all-time highs, with Nvidia, Amazon, and Apple leading the mega caps lower today. Deidre Bose is focusing on tech's role in the sell-off in today's Tech Check. Hey, Dee.
It's a big role, Melissa. Nearly $1 trillion wiped off the Nasdaq in the first hour and a half of trade today, almost $2 trillion over the last week. Here's a chart that sums up how closely correlated the yen and the Nasdaq have become over the last few years. Investors, they borrow money in Japan where interest rates are low, and then they buy tech, mega caps in particular, for higher returns expected, even higher thanks to generative AI. Except, of course, here's the rub: those higher returns taking longer than expected, and the interest rate dynamic may be changing. So the tech unwind is being hit hard. Nvidia, that's Gen AI's biggest winner. It's the laggard today, leading the Mag 7 lower. The others not that far behind. And performance over the last month, that's even uglier, suggesting that this isn't just the yen carry trade, it's fundamental as well. The latest mega cap earnings raised a ton of questions over returns and monetization in Gen AI. CEOs are saying the more capex, the better, while investors are increasingly focused and worried about the impact on earnings. On top of that, pockets of revenue weakness in typically strong businesses like Microsoft's Azure and Google's YouTube. Now, adding more fuel to those worries and the sell-off is a report over the weekend that Nvidia is delaying Blackwell, its next AI chip. So with billions of dollars in market cap lost in the mega caps, here is how valuations have changed over just a few weeks, especially amid a lot of that CapEx chatter. July 10th, when the Nasdaq hit a record high, you had 5 of the Magnificent 7 with forward price to earnings multiples above 30. Today, shares of only 2 of them, Nvidia and Tesla, are above 30 times earnings. So you've seen a big re-rating here. Alphabet and Meta continue to be the most reasonably priced. The bear argument that lofty valuations support the case for a rotation trade, that is fading somewhat. Meanwhile, the forward PE multiple for the Nasdaq at large, that sits at about 27 times. That is higher than the historical average, but still far from dot-com bubble levels. And a key difference between now and then, guys, our biggest tech companies, they are hugely profitable, liquid, and dominant in their fields. Our latest Tech Check Weekly dives into this dynamic and the looming AI trillion-dollar time bomb. Guys, in the weeks leading up to earnings, you had a number of units from Sequoia Capital to Barclays kind of sounding the alarm over generative AI returns and the huge amounts that these companies are spending in CapEx.
Wow. So you guys, I'm going to hand this off to my sister, Melody, because I need to take a break real quick. But I wanted to lead to ask first question to my man, Mitch. That's Jack, but my man Mitch is there. Mitch, where did that $1 trillion go? Where'd that go?
Travis.
Wait a minute, Mitch. It's you? Oh, wait. Oh my God, you're on mute. Good thing I didn't leave before I unmuted you. Sorry about that, Mitch. Where did that $1 trillion go?
The shares were transferred over to the banks. It's real simple. They took the investors' money by pumping the market down. I remember what I said. They can pump it up. They can pump it down. When they pump it down, they cause an inducement. When they have the pump down, they take your shares as the investor. And then next thing you know, you exit and the market's going right back up. So the next move for the banks is exactly what you're seeing play out right here. They're moving it up slowly today because as the market climbs, it moves slowly. The market takes the stairs up, it takes the escalator down. So it'll induce people to get in up to a certain point. And next thing you know, you're going to get an outside bear bar. And when that occurs, they're going to pump it down in the other direction. But either way, they're taking your shares or they're selling your shares. So what you're seeing here is a technical issue, not so much the fundamentals, and all the other stuff is just people making up stories to try and tie it to the chart that they know nothing about in the first place. But the underpinning to this always comes back to mom and pop. If mom and pop aren't healthy, then how can the market possibly be healthy? The answer is it can't.
Jack, you want to weigh in?
Yeah, when they were talking in that CNBC video a second ago, they said $1 trillion time bomb in AI. That is incorrect. It is a $15 trillion time bomb because that is how much the S&P has rallied since ChatGPT was released on November 30th of 2022. And keep in mind where we were when that was happening. Big tech was having a bloodbath in 2022. The market was crashing steadily and constantly when ChatGPT comes out of nowhere and all of a sudden the market decides AI is going to displace all the world's poor workers and it's going to be a veritable age of, Terminators and Skynet and whatnot. A $15 trillion stock bubble, not a $1 trillion stock bubble. And there is nothing supporting it. It is all hot air. The data centers are making money, but the data centers are only making money because big tech is giving money to the data centers' customers. The data centers' customers don't have products that make them money. Some of them don't have products.
$10 can help.
And case in point, Microsoft. All right. I want to let you guys know, like Microsoft took this big position in ChatGPT that everybody talks about. Oh my God, they gave them $10 billion and an $18 billion valuation. Microsoft only gave ChatGPT and OpenAI, they only gave them $1 billion in cash. The other $9 billion was data center credits, coupons for free GPU rentals. And now as OpenAI rents the data centers from Microsoft, they redeem those coupons for free data center rentals. And when Microsoft takes that coupon back, they report it as cloud revenue. So they're not actually making money. It's their own discounts making a round trip coming right back to them. There's no actual cash changing hands. And if you look at the free cash flow for big tech, they're saying, oh my God, this is different than the dot-com bubbles because big tech has all this money. Their earnings look great, but their free cash flow sucks because these companies are not earning cash. They're just earning back their own silly coupons that they gave to their customers who some don't even have products that they can sell. The few that do have products you can sell tell you to jump off the Golden Gate Bridge or glue your pizza together or eat at least one rock a day. AI is a vaporware bubble. It's the biggest bubble in history, and it's one of several crowded trades that we're watching unwind in real time here. And that's all I got.
Wow, Mitch, I got you. Mitch, let me take. I got this comment for you, Mitch. But did you want to kind of dovetail off of what Jack was saying?
Yeah, I actually want to do an underline on what Jack just said. If AI is so great, is there anybody in the United States that can tell me why I keep getting spam calls on my phone?
Melody, do you know?
Look, I worked in tech for the last 5 years, and I can tell you that the product graveyards are far larger than the successful projects because in many ways, a lot of it's almost as if we've forgotten how to finish something, because what would happen in tech is you would do just enough to IPO, and then you would piece out and leave a half-baked product that ultimately everybody kind of realizes doesn't work anymore, or never worked, honestly. And I think, you're not seeing anything different with this AI mania.
I want to do a quick market update because this is absolutely crazy. And then, Mitch, if you can help answer Austin. I know him as Austin. No, what am I talking about? This is my man, Sean.
That's Sean.
Also a super cool guy, Sean. But look at what's going on in the market, guys. This is crazy. Like, Jack, what the hell, man? The 10-year is now up 3.5 basis points, or 3 basis points on the 10-year. That's so insane to me. Oh my gosh, the 2 years up almost 7 basis points. I mean, this is absolutely insane. The VIX is now only up 40%. Bitcoin is down only 6%. Dow down 733. S&P down 98. And NASDAQ down 334. Wow.
Yeah, these moves in the 10-year, Travis, are just in the bond market. This is something to watch, right? Because I don't think anybody was really expecting this. And, there's a very interesting theory out there from Russell Napier about the Japanese who will start to repatriate their cash, basically on order. And so I'm wondering if what's happening right now, that the Japanese are selling those 10 years. Very interesting. This is definitely something to watch.
Dang, good perspective. Mitch, can you help with this one? Sean has been just a really cool dude. Epic. I almost said the BA word, like a bad A, but I'm not. This is Sean. He allowed us to come visit him in San Antonio, and what he's been doing, Mitch, a lot is he's been uncovering the fact that investors, specifically institutional investors, are actually selling the homes that they own, selling their single family residences in bulk, actually. But good guy, can you tell him what to look out for, Mitch, as far as uncovering appraisal fraud? Maybe 2 things to look for.
Okay. So on the website, mockingbirdproperties.com/DCAD is the answers to everything you seek. You don't have to reinvent the wheel. We've already done it. We're getting phone calls from attorneys as far away as LA, Canada, of all things, because they also use USPAP, which is Uniform Standards of Professional Appraisal Practice. And the problems that you're seeing start with that one simple statement that, as far as we have seen, no CAD at this point in any of these states that utilize USPAP is doing an appraisal as required in the laws of not only their state, but under the Constitution of the United States of America. In other words, they simply aren't doing appraisals, which is what their charge is. So what we've done is we've done the analysis. We can break it down by the house. That 37% comment I made about the households not being able to afford the roof over their head, that all stems from what is the median household income of any taxable county. So you can literally take what we've created, insert the median taxable income, and then the math will actually roll forward. And so if you have a 85,000 median household income versus 109,000, you just put in the 85,000. And then what you will see is that everything rolls down from there, meaning the majority of people, that same 37% keeps occurring regardless of the county in which the taxes are fraudulently being created. So the evidence you seek is on that website.
Okay, couple super chats before we go into the Mark Zandi video that Melody's been so excited to watch. Real quick, man, a lot of support from our dude here. Jack, did any banks make loans to UKR? Confirm if so. Wow.
I'm guessing that we're talking about Ukraine there.
That's what I was thinking.
I'm assuming UKR's. I'm sure that's been happening. I haven't really researched the topic, to be honest with you. My general point of view when it comes to the Ukraine conflict, and again, we're speaking purely from financial here, and it's not in any way meant to belittle the human cost. We're just talking finance today, so we're going to stick to that. What's really happening with Ukraine is a massive cash handout to the military industrial complex. Because when we hear about this aid package for Ukraine and this $60 billion, what we're not giving them money, we're giving them our old equipment out of storage, old Bradley fighting vehicles, old model Abrams tanks, F-16 fighters, fourth generation fighters, older ammunition stockpiles. We're giving them that stuff. And then we're using the $60 billion to buy F-35s, newer blocks of the Abrams, not really the Abrams, we're not buying tanks, but smaller light infantry fighting vehicles. So it's really a modernization of NATO militaries at the expense of the taxpayers being masqueraded as aid packages to Ukraine. We're using up the old stuff as the Russians feed men and material into the meat grinder, and we're buying new stuff to replace it. And case in point, like F-16s are just arriving in the Ukrainian battlefield today. Every F-16 that is donated to the Ukraine equals an F-35 sold by Lockheed Martin to the same countries donating the F-16s.
That was depressing a little bit. Melody, maybe you can get us out of this depression. And I'm talking economically. Personally, I'm happy because I've been preparing. So I'm talking economic depression. This is from Jack. Jack, thank you for the super chat, brother. We definitely appreciate your support tremendously. Now, this is Jack. I've said here for over a year, a greater depression comes after an emergency rate cut, which is possibly going to happen due to major black swans. I believe some of those black swans, other than the unrealized losses, is obviously commercial real estate. I mean, obviously it's commercial real estate and fraud. Thank you, Mitch, for that one. Unemployment will skyrocket. No one is prepared. Hug your loved ones. Make new memories. Can you just clean that up, Melody, and put some hope, a little bit of a hope spin on that? Because that hurts. But a lot of people feel that way, especially if you're not prepared.
Sure. So I think most of you guys know that I think we've been in what I call a silent depression. That was Emil Kalinowski's term since 2007, that the media has really been just gaslighting on steroids to keep us from realizing it. But I also believe what Jack is saying, that essentially this is going to be a even greater depression. And, I don't call them black swans. I actually call them gray swans because are actually gray elephants. And that's a book by Michelle Wucker. But that's about the fact that really we could see all these things coming. That's why our channels exist, because you could actually see this coming. We talked about the carry trade several weeks ago, but honestly, I was reading and thinking about it almost 3 years ago. And so these things, you can see them coming if you're paying attention. And really, that's why our channel exists. And so, I hope, guys, that you realize what we have been trying to do is give you the tools to make the best decisions possible, especially when things like this happen. And when it comes to sort of the emergency rate cut, maybe Jack, you want to take that one?
Yeah, I said it earlier in the stream. I'll say it again. I think an emergency rate cut would be a huge mistake by the Federal Reserve. And I think not cutting would also probably be a mistake. We're basically in a point where we're screwed either way, no matter what we do here, one way or another. But an emergency rate cut would freak people out when it comes to inflation, because unless you're Paul Krugman or Claudia Sahm, right, 85 to 90% of the public does not feel like inflation has been defeated, because 85 to 90% of the public doesn't give a shit about the rate of change of prices. They give a shit about the absolute level of prices, which are unaffordable for everything. And they are still struggling with that. And it is no comfort to the average person that PCE is within striking range of our arbitrary 2% target. They don't care. All they care about is they have to put buy now, pay later in place to buy groceries. And so if they find out that they're turning on the money printers again, an emergency rate cut with transitory still fresh in their minds, they're going to spike long-term inflation expectations. Long-term inflation expectations will drag long-term interest rates higher. An emergency rate cut will be a huge mistake if the Fed does this. They'll cause an inflationary panic, and it's going to have the opposite of the desired effect on interest rates and liquidity in the market.
So do it, I say. I'm trying to get to Zandy, but Mitch, I've seen this question a couple of times. Maybe you can I want to test your skills, Mitch. I want to see how you can relate to this person here. So how does this affect the average American that knows nothing about the stock market? Can you kind of just sum up? Can you sum that up, Mitch?
You don't need to know anything about the stock market if you're not participating in it. It's not relevant. The only thing you need to understand is what's happening around you with regard to your cost of living. And what Jack was just saying is if they turn the printing presses back on, the reality of it is you will end up in hyperinflation. And so certain items get hyperinflated while the rest of the market is cratering. The printing presses are in fact a fraud on the public, the same as the CADs are pumping the values of real estate to take taxpayer money. They are the exact same situation. Inflation is taking taxpayer money. Creating fraud at the CADs by hyperinflating the real estate values is taking taxpayer money. So do you care what's happening in the stock market? No, you have to understand what's happening around you. And unfortunately, it's going to take tens of thousands of people stepping to the plate in order to stop the nonsense at the CADs, where they just simply file enough suits and that breaks the CADs, and or you force your state legislatures to make the appropriate changes. But either way, mom and pop under these circumstances is going to be decimated, and it will eventually float its way up to the banks, because if deposits, all of a sudden you start having runs on banks and one problem after another, this can get wicked real fast. But the Fed in and of itself put itself in this position, which is why I've been a proponent for shutting down the Fed. They haven't gotten anything right since the day they were open as a result of the Great Depression. They're purely reactionary. They've stalled off nothing. And they're playing games on both sides of the table and superimposing a fraud that shouldn't exist in the first place is why we are where we are. Like I said, if mom and pop are not healthy, then there's simply no fundamental answer and no technical answer why the market should be healthy either.
You know, and I'm desperately trying to get to Zandy. Melody and I will knock that out. I think this is more a question to Jack right here. Best you can, Jack. Thank you for the support, Midwest Boy. We appreciate that. And before we go into Zandy, I'll do one more market update, because the market has recovered slightly from how the bloodbath this morning. It will probably change. Here you go, Jack. When we donate weapons to Ukraine, are we running up Ukraine's debt to us that we will later take from them in the form of minerals, metals, oil? What are your thoughts on this?
I believe this is just economic aid. I don't think these are loans we're making to Ukraine. I think we're just giving them the stuff. But I do think there is probably an implied, assuming things go a certain way in the outcome of the war, that American companies would probably get the development contracts and benefit from things like minerals, metals. Certainly the U.S. Liquefied natural gas industry has benefited tremendously from the conflict in Ukraine and the embargo of natural gas and the shutting off of the pipelines and the destruction of the, I can't even remember the name of that pipeline, the Nord Stream 1 and 2. So U.S. companies are going to benefit from the metals and minerals extraction, even if it isn't actually debt that we're giving the Ukrainians. I believe we're just giving them the stuff outright.
Okay. And we got another super chat. I'm going to come back here, SD. I'm sorry. I'm going to come back here real quick, but I really want to get into this video, and then we'll do a quick market update. I want to get Melody's opinion on this as well, but I will come back to you. We will answer that. And again, thank you for the support. You guys just let me know if my audio is okay, and I appreciate you.
Mark Zandy joins us. Mark, a lot more people coming over to your camp that the Fed's been late, at least when it comes to rate cuts. But we're going to still be waiting for September, right? They're not doing anything between now and then, are they?
No, I don't think so, David. Generally, the Fed keeps intermediate rate cuts to real crises when there's dislocations in markets, when trading breaks down, when banks stop lending. So I don't think we're anywhere close to that, and I think it would smack of kind of panic, desperation. I'm not sure what kind of response they would get. So I would at least at this point, I mean, obviously a lot of script to be written here, but at this point, the script doesn't say, cut intermediate. But when they get to September, it does feel like they should be cutting much more aggressively. And, the other thing they could do and probably should do is signaling through speeches and press interviews and everything else that they are ready to cut and they're going to cut and they'll do whatever is necessary to make sure the economy stays out of recession. But an intermediate cut, that I think they'll save that if something really goes off the rails.
Yeah, well, why don't you tell people again why you believe 50 basis points is more appropriate and why you have been calling for rate cuts previously?
Well, they hit their mandate, their target. We're at full employment, and in my view, inflation is back to target, appropriately measured. And even by their measure, we're back to target. And you can even argue with that 4.3% unemployment rate we saw on Friday that, we've blown through full employment. My estimate of full employment is something in the high threes, not 4.3, and all the trend lines suggest unemployment is going to continue to rise. So if they've hit their mandate, and then you got to ask yourself why, if that's the case, a 5.5% funds rate target. There's a lot of reasonable debate as to what the so-called equilibrium rate, that rate which is consistent with policy neither supporting or restraining growth. So I get that, and it's probably a lot higher than it has been historically for a bunch of reasons. But it's not 5.5% or even anywhere close. So they got to get the rate down to something closer to equilibrium, and that means 50 basis point cut in September, another cut maybe at the November-December meetings. They got to get it down to around 4% here pretty quickly.
Do you think that the odds of recession, Mark, have gone up given Friday's jobs reports and given your expectation that they will only cut 25 in September?
Indeed, and I said 25 on Friday before today's market action. So maybe that if we see another, down 5-10% on the market, and it starts showing up in consumer spending, which it very well may, because high income consumers are driving the train and they're focused on their stock portfolios. So the conditions could change very rapidly, and they would go 50 basis points. But I think everything points to a much more aggressive rate hike. But I don't think rate cut. But I don't think recession. The economy is resilient, and the best measure of recession, far and away, is simply jobs, employment, payroll employment. And Thursday we were at 114K. That's obviously being affected by technical factors, Hurricane Beryl. We're probably underlying job growth 150K, 150,000 jobs per month. That's nowhere close to a recession. So I don't think that's likely. But
I mean, I'm almost speechless. Melody, I want you to
like
respond,
to share my screen.
girl, I already did, girl. You
So
roll
on
with it.
July 31st, Mark Zanny. So July 31st, what is today, guys? August 5th. Okay. So he said the Federal Reserve stuck to script, holding monetary policy unchanged, but strongly suggesting a rate cut is likely in September. The inflation data must cooperate for the Fed to follow through, but all indications are that it will. Global investors are cheered by this. Stocks are up a lot and bond yields are down, as they should be. The economy is set to soft land. Yeah. So here's the thing about these guys is they're looking in the rear view mirror always, which is why they never see what's coming. So you heard him. He said, "Oh, I thought it would be 25 basis points. And then I woke up today and looked at the markets." Right. Because he has no real theory on what's actually happening. He's just reacting. And this guy, the executives at my company, even when those of us on the risk committees, those of us in financial planning analysis, were trying to tell our executives, look, things aren't getting better. This doesn't look like it's going to turn around. Who did they listen to? They listened to Mark Zandy, and we followed him all the way to One Bowling Green in New York City in bankruptcy. These guys don't care about you. They don't care about Main Street. They don't live on Main Street. They don't do deep analysis. They just react, and they go on these television shows. And why anyone is listening to them is beyond me. You can go back to 2007 and 2008, 2009, 2010, see the most ridiculous statements from this man and his peers, like Larry Yoon at NAR, however you say his last name. Sorry. I told you, Travis, I didn't want to go to jail today. This just makes me so angry because these guys have no skin in your game. And yet all these people, including industry insiders, follow them right off the cliff.
Every time. Real quick shout out to Jack. Jack's got to go here shortly. So I want you to take this last super chat if you can, Jack, just because I know you got to go in a few minutes here. And real quick, guys, before Jack answers this question, don't forget, this man is putting in a ton of work for us. He's helping our community. Just go over, to Nobody Special Finance, give him a like, give him some comments. Obviously, we're also part of DNN, but for the sake of what he's doing today, go to his main channel right here. This is a great man. Jack, can you go ahead and respond to these comments here?
So, too late for inflation. Our service price for debt surpassed the DoD budget. Half, 45.5 of our income tax went to paying its print from here. So, talking about the servicing cost of our 35, is it 35.2 trillion yet? I mean, we just broke 35 a few days ago. But the servicing cost of our $35 trillion in debt is now more than our defense budget, which is already astronomically high, half of all tax receipts. So what Mr. Duck here is alluding to is the inevitable insolvency of the United States government. And that is accurate. It is mathematically not sustainable what we've been doing. With an asterisk, there is one way we can sustain these ridiculous bloated budgets forever, and that is to turn on the easy money again. That is to start Zerpenberg, zero interest rate policy, and money printing, right? Because that's the only way out of $35 trillion of debt, is to inflate it away. Problem is, you create other problems for everybody else. And that's why I think, again, it would be a mistake to turn on the money printers now. And I think what Zandy was saying there, the 50 basis point move in September, I think that would be a mistake also. Because if the Fed goes 50 in their first move, then the Fed is admitting that they waited too long. They're admitting to the public that they don't have a good handle on this. They're admitting to the public that the soft landing talking point that even Zandy was parroting is a bunk BS talking point, that it was never real. You cannot hopelessly soft land your way out of a $35 trillion debt and trillions of dollars in QE. And look, everybody's saying the Fed made a mistake by not cutting. How can you possibly defend cutting interest rates with stocks just a few points off of all-time highs? I mean, zoom out on an S&P 500 chart or a NASDAQ chart. Zoom out 10, 15 years. How can you possibly defend cutting interest rates with asset valuations that high? Zoom out on a chart of median home prices. How can you possibly defend cutting interest rates, further inflating home prices when the average person already can't afford it? What they're telling us, what they're not saying, is these interest rates are starting to hurt my bottom line, me, the rich guy, the asset owner. It's starting to hurt me. I don't care about the 90% of the population who's already going broke from inflation. Make it worse for them. Just permanently and forever inflate my asset prices. And then we can all sit back and wonder, why does the wealth gap in this country just keep getting bigger? I don't understand it. Maybe we need to change tax policy. No, it is the central banks and the government that's doing it.
Okay, that was hardcore, brother. Thank you, man.
And guys, real quick, I'm sorry, Trav. I do have to drop off. It's been a pleasure. Thank you for having me. Mitch, Melody, always a pleasure as well. And thank you, everybody, for watching. You guys are awesome.
Thank you for your time, Jack.
Yep.
All right, so I'm going to make our way around the market. We've had some movement in the market once again, and then I'm going to go into the crypto sell-off. So we got another breaking video coming out on the crypto sell-off, but take a look at the market. So we've gone flat again on the 10-year. We've lost a little bit on the 2-year. It's still up 3 basis points, but take a look at this. This is interesting. For some reason, the VIX is still losing some steam. The market is not. Bitcoin's still down 7.5, 7.6, but take a look at the Dow. The Dow's down again, passing the 800 threshold once again at 908. So possibly that intraday I don't know, rally. I'm not a stock professor here, but it looks like it's trending downward once again. So Dow is down 907, while the S&P is down triple digits once again at 133. NASDAQ down a whopping 480. A lot going on here. A lot going on here, guys. Let's move in. If I could get both y'all's kind of comment on crypto. I don't know too much on crypto, but we're going to listen to our next video that is on crypto. It's on today's crypto sell-off. Maybe we can get some gold here. Hopefully we can. And if you guys can, tell me that the audio is all right. I can't hear the audio.
Over to Mackenzie Sagalos. Just tell us what's going on here. Of course, store of value, not today, I guess, Mackenzie.
No, certainly not today, David. More than $370 billion wiped off the overall value of cryptocurrencies and more than $1.1 billion in liquidations in the crypto futures market in the last 24 hours as investors sell out of risk assets. You've got Bitcoin dropping to nearly $49,000 at one point today. It's begun to pare some of those losses, still down more than 10%. Meanwhile, you've got Ether firmly in the red for the year. Crypto-related stocks like Coinbase, Riot Platforms, Marathon Digital, and MicroStrategy are all trading lower this morning. Now, there are a few things that are happening here. Crypto prices began to fall after that weaker than expected July jobs report last week, which helped stoke recession fears. But the panic selling really began to accelerate overnight during Asian trading hours when we saw a broader slide in equities in Asia Pac markets. It also comes as the Nasdaq is now in correction territory following the latest tranche of disappointing tech earnings. So a lot of this is just a knock-on effect from the wider market and a sell-off in risk assets. But what's different this time around is the fact that it's the first time that a correction of this magnitude will be felt by a broader base of investors after the SEC approved spot ETFs for both Bitcoin and Ether. These funds have seen tens of billions of dollars in flows since launching, and they've brought new traders into the market, with Morgan Stanley reportedly allowing its 15,000 financial advisors to start pitching Bitcoin ETFs to its clients starting this Wednesday. There's a big question about risk appetite and whether we're going to see Wall Street buy the dip or flee. Melissa?
Bravo date. Find your soulmate.
Alrighty, so Mitch, and you still got time, Mitch, to be with us today?
Sure.
All right, good. I think, Melody, maybe I'm wrong, but I think maybe Mitch could knock this one out. You know anything about metals?
Yeah.
You never cease to surprise me. Man, by the way, I got up at 2:30 a.m. to get a video out. My brains are scrambled right now. Why are precious metals, quote unquote, undervalued? And Mitch, in your opinion, is silver still undervalued? And Melody, I see you. Thank you for your time.
So gold right now is only down 1.03%. I just looked at the chart a second ago. The Bitcoin is down 13.21%. So at the beginning of this video you put together, we talked about the clustering effect. So as I look over, the majority of the indexes, which includes gold, they're all down. But Bitcoin is way down, and Ethereum is down 17.21%. So the clustering effect, which is in the case of the Bitcoins, in reality, you have a problem, which is you can't trade them. In other words, they don't have options supporting them. So if you buy a Bitcoin, you put it in your wallet, or whoever's holding that Bitcoin for you, that means you're just simply long Bitcoin, and the only way out is you have to sell it.
Sticking with the tech side.
When you see a massive amount of devaluation like you're seeing today, that's people just wanting to get their hands on cash, because there's no options market from which you can maneuver around Bitcoin futures or Ethereum futures. So you get this massive panic, and panic's not the right word, but it is a technical situation where people are getting out because of the clustering effect. And then when you look at gold, down 1.3% as compared to Ethereum or Bitcoin, well, that kind of tells you the truth, in that the precious metal markets are being upheld by the governments around the globe that have been buying. So as you look over at silver, it's also bouncing off of its low, which basically tells you that the big banks have stepped back in and they're buying. So gold just a few days ago was at its all-time high. In other words, this little dip in the last couple of days down 3%, who cares? It's only 3% off of an all-time high. It's all good. If you're in the precious metals market, if you have a brain cell, you're saying buy, buy, buy. You get a dip like this, like we had this morning on silver, yeah, it's a good thing to stick your toe in the water and nibble a little bit.
I think this is where we have to remind everyone that this is not investment advice.
Absolutely not. This is
okay.
Going in a little at a time, and don't ever
Yeah.
go over your account. So we nibble on these things because we're long-term holders.
Yeah. So, Trav, what I would like to say about what's going on with Bitcoin is that for a very long time, kind of since this carry trade really started going nuts, as well as the option markets, you could always look at Bitcoin and know when somebody needed liquidity in the marketplace. And so what I believe is actually happening today, because it's become such a speculative asset, really getting just a little bit of that juice, getting that collateral or liquidity, maybe because they need to redeploy it elsewhere in the system. But, I always look at it as a liquidity indicator. And what we're seeing here, at least early yesterday and this morning, is that there were collateral shortages across the system, and people needed to get that liquidity out. Kind of like, as Mitch was saying, the way that you do that is to sell. And so it's strengthening here. But I think that's probably because we've had intervention in the markets as the trading platforms were down for retail. So I think we're seeing a little bit of strengthening of liquidity across the board. But based on what I'm seeing and hearing from some of the people I trust, this won't hold up much. It won't hold up here likely over the next several days. So I don't think we've seen the bottom in Bitcoin.
Okay, very good. Go ahead, Mitch. Did you want to add something?
Yeah, the situation, you have to stand back. I keep saying, look at things in baskets, right? And you have to look, this is what's happening over here with regard to Bitcoin. This is what's happening over here with regard to the central banks on precious metals. The central banks have been buying for a very long time. And this idea that we're not in a recession and headed to something much worse is complete nonsense. And the proof of that is that we are in a recession. And if we weren't, these central banks around the globe, i.e. China, Brazil, they're all acquiring massive quantities of gold. I mean, we're talking by the thousands of tons. So the only reason somebody would jettison a position who is a long-term holder is because they had a margin call this morning. So if they hold Bitcoin, it's readily available cash, and you can't trade around it. In other words, you can't necessarily hold it with options, and you get a margin call. Well, fast place to go is your own Bitcoin account.
I want to draw the viewers' attention to some updated information with CME FedWatch. I mean, I'm just so blown away by the emotion in the market. We see this actually matching the slight recovery in the stock market. Look at how CME, basically the market's expectation on what the Fed does next, look at how it's shifted massively just in the amount of time we've been talking. This was what, at 95%? So the market is settling down, like you were warning about in the beginning, Mitch, how everyone kind of needs to calm down, see how things play out. So this went from 95 to 84, and also December has adjusted as well, where now they're anticipating a 46% of the market is anticipating 125 basis point rate cut. Good morning, Julius. Nice of you to join us, buddy. Where you been? Why aren't you liking my post on X Twitter? Dude, I mean, all I hear from Julius, and you may want to talk to him, Melody, is how I look like Ted Cruz. I don't see it, but it is what it is. Now, I'm going to move on a pretty important video on Nvidia. All right. Now, Melody, Mitch, has been pointing out how, she believes a lot of the liquidity, whether it's in regards to consumer purchasing power. So a lot of the liquidity for consumer purchasing power minus consumer credit card debt and things like that, a lot of that comes from the stock market. A lot of it comes from Nvidia because it has been doing pretty good. So that may be a small source of inflation. Oh my gosh, Ted Cruz's beautiful head of hair. Thank you, Raymond. I like your head of hair, buddy. I miss you, Raymond. This is a soldier right here, man. I love you, man. That's all I'm going to say. Now, I'm going to get to this video. If you can, Mitch, pay attention. If you can, Melody, pay attention. This is going to be a big deal to anyone that basically has a retirement account, pension, anything at all in NVIDIA. So here, let's do our video. If you guys can, in the comment section, let me know that the audio is all right.
Could this be an opportunity for investors to buy the dip? Joining us now, Harvest Portfolio Management CIO Paul Meeks. Paul, great to see you with us, have you with us. I'm going to read your words exactly. I want to be clear that this is what you're saying. I think that this correction will bring one hell of a buying opportunity in select tech stocks. Are we there yet?
I don't think so. I think we have to at least get through the earnings reporting season. So give me another week or two. I'm also looking at some specific tells this week. One has just taken place. That is the sell-side conference presentation by Micron. And then the other one comes with Supermicro's quarterly announcement after tomorrow night's close. I think we're getting close, but every time I hold off, and I've been holding off buying my favorite names since well before this earnings cycle, it just seems to be a better day to hold off and get them lower. I'm looking now, not necessarily at the fundamentals, because I'm convinced in the fundamentals of these companies long term.
Well, when it comes to fundamentals, though, Paul, if I could just jump in, I mean, we just heard Deirdre refer to the multiples, they've come down in some cases, quite a few turns. Is that not encouraging to you? Is that not a reason to perhaps consider from the fundamental perspective getting in now?
Oh, fundamentally, I really like these names, and I concur with the valuation argument. Some of these stocks are looking really attractive, and I think these stocks should be viewed not just on absolute PE ratios, but PE ratios relative to their growth rates. And in that regard, Nvidia is about as cheap as it gets, and I really believe that. But these days, I've been spending much more time on technical analysis than fundamental analysis. I just need to see the stock stabilize for a couple of sessions at some sort of trough level, and the valuations should continue to be good, and then also the volume to dry up. And so I don't like necessarily being a technical analyst, but I think that's going to be the greatest insight as to when you get back in these names.
On that report from the information, Paul.
I've heard enough. Okay, I've heard enough here. I don't think we need to listen to any more of that. But, just like Raymond says, starting with humility, is NVIDIA's cheap. Is it too big to fail? Is NVIDIA too big to fail? Is it too big to collapse?
No, it's not. But there are a lot of vested interests, so it could take longer. Just as I think for the longest time, people looked at Tesla, people who were really diving in and could not see or understand how they could be successful, that really they were running on their carbon credit success and subsidies. And you can see how long that took to play out. So these things can take time, but they are not too big to fail. However, you're going to see people, and we've seen it in the past several weeks, people exiting these positions, especially insiders. And often that's what has to happen first before they're allowed to fail.
Okay. Hardcore. Mitch, can you dovetail off that?
Yeah. What you heard from the video are half-baked statements. And I have a problem with that because it misleads people. You have to understand what time frame is he talking about. Notice he never said a time frame. Well, I think we should just go long Nvidia. Well, based on what? Do you have a fundamental reason? You think that a 30 PE is a fundamental reason when the reversion to the mean indicates a 13 PE? Great, let's go long Nvidia on something that's 2.5 times what its market cap really should be. So you see the problem? If somebody says, well, I'm going to go long Nvidia, I'm going to own it till the day I die, do whatever you want. But if you have a shorter time frame window and you say, well, I just want to own this for the next 7 months, well, now you go into the options market underneath NVIDIA, go out 7 months and look at what the statistical probability is of NVIDIA shares being up. And you determine that because if the skew in the puts is greater than the skew in the call, but clearly NVIDIA would have downside draft. They'd have downside skew. He mentioned nothing about that. And that proves that everything he was just saying is nothing more than a pump.
All right, we'll move on. I got another video from Bloomberg Television that is going to go into the global market sell-off, how that's going to impact the U.S. But did you want to add anything to that, Melody?
I'm good.
You're good? I know you're good. Let's look at the market real quick, guys. Just want to see because it's intraday right now. So we'll see if there's any intraday changes. The 10-year's just, Melody. Oh my God, Melody. It's only two. What is going on with the 2-year? My goodness, people just cannot make up their mind. That's only up now 2 basis points. The VIX, 42 now, up 42. Bitcoin down 7.3. This is insane. 718 on the Dow. S&P, we got 136, and NASDAQ not quite 500. Holy smokes. Let's move into our video right now, guys. Let me kind of just cue this one up here. We're going to go into this. Real quick, Melody, how you doing this morning?
You just asked me that, Trev. How are you doing?
All right, it's an ad.
I'm good. I was buying my time because I was trying to set up this video. How you doing, Mitch?
How many energy drinks have you had this morning, Travis? Is it a 2 energy drink day, 3, 4, 5? Where are we on the energy drink scale?
That's none of your business. All right, guys, we're gonna move on to the. I've had a few. I've had a couple. I mean, when you got children, and I mean, geez, Louise, here it is, right? And I'm trying to keep up with Mitch. We got all this stuff going on, and we got all these. Mitch, we probably got like 50 whistleblower emails that we got to respond to. Which, by the way, if you're a whistleblower, thank you for reaching out to us. We're getting to it. We're trying to keep the story together. Massive corruption, massive overvaluation, fraud. Really hard to comprehend how deep it goes. I know energy drinks are really. See what I'm talking about?
See what I mean? I agree with Ray. I've told him, Ray, so many times how bad they are for him. Yeah.
You guys are getting the wrong impressions here, man. I'm a father. Okay. I'm not doing, ain't no white chick around here. Anyways, guys, let's move on to the video now on the global meltdown. Melody thought that was funny. Surprised she understood what I was saying there. Interesting. We'll talk later about your past and how we've grown from it. I'm digging myself a hole. Mitch knows it. Let's see what's going on with the global meltdown.
The global funds have been levered to a carry trade that has been unwinding, certainly since the Bank of Japan raised rates and the Fed kept still. And now the divergence between the rates are widening, and it's unclear how much more pain there is to come. And joining us now is Liz McCormick, Bloomberg's chief correspondent for global macro markets, and explain what is happening here with this carry trade that has existed, because you can say that this is really somewhat of a generational shift as we watch this divergence, but unclear how much it has meant for this trade to unwind. Explain the trade.
Yeah, well, let's remember the trade is forever. Rates were so low in Japan, for example, and it made sense to borrow in that currency. So in a sense, short the yen and invest where rates are higher, the U.S., Mexico, et cetera. Now, the key to the carry trade, a carry is like you sit there and make carry, interest rate differentials. But the key that it really works to is that volatility is low, because if the currencies move against you, you could lose a lot on the currencies. And that's not only, like you explained, the yields have started to kind of go the other way. Bank of Japan raised rates just a little, but they started. And like we can see, and you've been talking about how much people are pricing in, the Fed's behind the curve. We're going to have these massive over 5 cuts this year. So that rate differential got turned on its head somewhat. And volatility. People are like heading to the hills, like you're talking in all these asset classes. When you see this route begin, it just escalates other things. So people are like, this carry trade, which seemed like the easy trade, is no longer. So you start exiting fast and it starts to be self-fulfilling, unwinds and unwinds and unwinds.
And I guess that's what we've been trying to get at all morning, is kind of understanding the chain of events here. So if I am managing a big multi-asset portfolio and, oh my goodness, I have to unwind my carry trade right now, how does that exactly affect other parts of the portfolio? How does that translate into Nvidia being down double digits?
Well, remember, and I think it was the BIS, don't hold me to it, but they did say the carry trade was like expanding to broader things. And Matt, you were joking about Nvidia, that, you can invest where yields are higher in, say, the US, and you could buy stocks. You don't have to be in fixed income. So it seems like it's all building. Now, we don't know all the data where these people are, but say they're unwinding this carry trade and some of that money was going into stocks. So that's adding to it. And I think what happens too is it's like a self-fulfilling, right? People say, oh, it's not going to go that far, but maybe I better get out, like you just, and it starts to feed that fear, that fear
Right.
concept. So I think it's all kind of breeding on itself.
If you take a look at, just a simple yen chart, you can understand why the trade is so attractive, right? It's been weakening for so long that it made sense. You can just short the yen and use the proceeds from that short to buy Nvidia, because Nvidia has been climbing and climbing and climbing and climbing. Now, we saw a dip. You can see this is a 5-year chart here. We saw a dip in the yen at the end of 2022. That probably put a damper on carry trades for a while, but surely they came roaring back to life. This isn't the end of it, is it?
No, and I don't want to date myself, but I've been through a few of these cycles where, the trade works until it doesn't, and then everybody's out and they call the death of it and they come back, because that's just human nature. And it is a good strategy, of course, when it works. So it just...
I'm sorry. I just can't take any more. Melody, I threw this comment. I want you to start, Melody. You see Mitch over there? Mitch, you been drinking coffee or what?
Espresso.
Sorry, so fancy. This is Melody. You don't need a fixed income, just buy stocks, she said. What do you make of? I don't even know what to call it anymore. Melody, is it over optimism? Is this just at this point? Is this just fraud?
It's willful blindness. It's bubble vision. I mean, they have a role to play, right? And they're sell side analysts. That they're always, just as the unscrupulous realtors are always going to tell you they got multiple offers over asking. These guys are always going to tell you it's a good time to buy stocks. And again, they're paid shills to some degree, and this is kind of how it works. And so really, what we try to do here is give you more information so that when you hear people say things like that, you can immediately respond with why that is a terrible idea. And I think everything you guys have been learning on our channels, and especially when it comes to stocks, what you've been hearing from Nobody Special, from Jack, this is a huge bubble and there's going to be so much pain. And, honestly, Jack has put his life on the line, in my opinion, to bring some of those stories to you, very dangerous stories about how much corruption there is in this AI trade. So, that somebody like the lady that was just speaking she's not going to put her life on the line for you.
That was, I mean, that's pretty strong. Let me ask you, Melody. Let me just ask Melody something else here. And Mitch, my wife has even talked to me. So if they come at me, you better get my back, bro. I'm not even kidding, Mitch. This is live right now. You better make sure you protect my. I almost said the A word, but Melody, let me ask you. I mean, seriously. I mean, are you scared at what's coming?
I would say no. I feel prepared. I've been making radical changes in my life. And of course, I don't know exactly what's coming and I can't be prepared for anything. But this is where, Travis, you and I talk, and our faith will step in for anything that we don't feel prepared for. But, both you and I, because we've been through this, we've been through the trenches or in the trenches, and we knew what was happening. And so we both started making a lot of different decisions about how we needed to get ready for this. So I'm not afraid because of that preparation as well. And more importantly, because of my faith.
You got me with the faith thing. You punched me right in the stomach. I was about ready to go off, like, yeah, I'm going to go off now. And faith. The Holy Spirit will not let me. And I believe in the Holy Spirit, and just, I don't want to go into religion, Melody, but thank God for Jesus. That's all I'll say. I pray every day. I'll say a little more. I pray every day. It helps me. Mitch, let's kind of segue a little bit. I'm keeping my eye on the markets. The Dow's kind of declining a little bit more, may hit actually quad digits here. So we'll get into that. But can you give the viewers an update on the lawsuit that you have right now, and how people can help and what they would be helping with as far as your petition? Can you just give us, maybe like a 3-4 minute summary of your lawsuit and how people can help?
Yeah, just before we do that, with regard to that prior video and what Melody was saying, there isn't a single person, not one, who actually could execute a carry trade who is on the news networks talking about it. Therefore, what they've done is they've created a story around a narrative that simply isn't true. What's happening in Japan has to do with birth rates, which are negative over a long haul. Japan's been problems for a long time, but that's the crux of what their problems are. And if somebody was lending long and borrowing short through a carry trade, well, you get what you deserve, because it's a stupid position to be in the first place. So if these shills are providing cover for these banks, then that's what they're doing. The story, unfortunately, means absolutely nothing, because the people who are making the comments literally could not execute a carry trade. With regard to what we're doing in the lawsuit, on mockingbirdproperties.com/DCAD is an outline of everything. All of our evidence is there. We've posted it there. Videos are there. What we're asking people to do, it takes about 10 seconds. If you understand what's happening around you, which is to your point about how not to get depressed over all this, you simply have to understand it and then do the best you can to step to the side. Well, with regard to the petition, that's people's way of saying, okay, we understand it. We know that we can't tackle it with lawsuits or constitutional lawsuits like we're doing, but filling in that petition is our way of showing the judge and or judges that this touches the lives of every real estate taxpayer. Whether you're a multifamily tenant, you pay the taxes. Whether you're a single family homeowner, you pay the taxes. Whether you're a commercial property owner, you pay the taxes. Anybody who is affected, we're asking, take 10 seconds, please, just go and fill in the petition. We don't share the list with anybody. It's something we're simply going to show with the judge or the judges as we go through the process.
Melody, was this a big surprise? I mean, have you learned anything from Mitch? Was this a big surprise? I mean, we knew, you and I knew fraud, corruption, but I feel like even though like you and I, Melody, are sharpening each other, it's just like every other day we're learning some other new area of corruption and some other new area of fraud. I mean, what have you learned over the last couple of weeks from this situation, Melody?
Yeah, so I think, Travis, you and I talk often about the fraud, the embedded fraud. We knew something was not right on these appraisals. You jumped into that story. That's how you got connected with Mitch. We have been saying for some time, especially on the builder side, something just didn't make sense. These values didn't make sense precisely because when you look at household median income, folks out there can't afford these high prices. So we knew the fraud would show itself. We knew it had just started. You just started to get court cases. You just started to get bankruptcies where interesting things were coming out, title fraud, things like that. But I think it's always shocking, no matter how much you know that the bezel is completely in full force, and that is that embedded fraud that you can't really see until it's too late. I think that this is the fact that so many people at a county level, and that this is so embedded within these state and local governments. I think that is truly shocking. So I can be, this is an example of you can be prepared and know it's coming, but when you see it, it's still very shocking.
We have an update real quick, guys. So we did have an update. There will be an additional update later today, but the rates are changing. This is residential mortgage rates are changing so quickly. They've already done one update. Very interesting. I mean, this is down 6 basis points. The 10 years actually reversed. So really the market doesn't know really what's going on, but nevertheless, interest rates did go down. I thought that was interesting to see that in advance of market close. So we're down to 6.35%. Very interesting. Now we're losing a little bit of momentum downward on the Dow, being down 898. So a lot going on, guys. Mitch,
Yeah.
what do you think happens next to the American consumer, the everyday normal American consumer that have their head in the sand?
Well, it's hard to have your head in the sand when you go to the grocery store and you see the price of orange juice. That's going to tell you that there's a problem. But if you have a car, your cost of fuel being bopping up and down, I mean, looking at oil right now, it's pretty stable. But the point of the matter is that these are inflationary costs. So when you go to the grocery store and then you have fraudulent real estate taxes that you are in theory obligated to pay, we'll see how that goes over the long haul. And your cost of living is such that you have to make a decision between putting food on the table for your family or paying the rent or paying the real estate taxes. If you're making $300,000 a year, yeah, maybe you can put your head in the sand. But if you're not, you can't put your head in the sand. If you're living above your means, you can't put your head in the sand. If you have credit card debt that is out of control where you can't pay it off within 30 days, you can't put your head in the sand. You're living in a tornado. And that tornado has got to be calmed down so that you see clarity. And you have to know that you're not alone. There's millions of people in that problem. And that's clear based on that comment I made, which is 37% of the population in Denton County alone, based on $109,000 median household income, is going to lose the roof over their head and or they will go bankrupt. So you cannot put your head in the sand. You have to understand what's happening. You have to appreciate what's happening. And then you have to make adjustments so that at least you're not going to get kicked in the stomach. And that's where we are.
Okay, very, very good. All right, well, you guys, we're going to start wrapping this up here. We've been, Mitch, you've been live the whole time. We've been live for about 2 hours, 53 minutes. And, before we go, I just wanted to see if there's any comments maybe that kind of just stand out here. If you guys have any questions, I'll try to pull up maybe 1 or 2, maybe 3 questions before we get out of here. And also, quick shout out, we will be going live for market close on DNN. Is that right, Melody?
Well, yeah. So I know that Jack goes live on his video, so we'll try to coordinate with him. But I think the next time we really want to be paying attention to what's going on is probably after about 2:00 after people get their margin calls. so, that'll be a very interesting time. Yeah.
Yeah, so we'll wrap it up on DNN. Don't forget to go there, guys. That's usually where we go and do our lives. Let's see here. My question is can I have $1 million? I'm just going to go ahead and answer that. No, you can't. Not before me. Do you understand that values won't fall if they want fraud to continue? I mean, I would say that. I mean, there's a fair point there. I mean, the fraud has kept things propped up a little bit. Let's see. Creating a fake cash flow only works for so long stock buybacks or the. You want to knock out those buybacks or what, Mitch? You want to talk about those buybacks?
Yeah, sure.
Go ahead. It's yours, brother. Yeah.
So the stock buybacks only happen on a handful of companies. It's really not that many. So if you see Nvidia showing up and saying, well, we're going to do a stock buyback, it's not a good sign, because the reality is that means that the company itself cannot take that cash and reinvest that cash in a higher yield than the cost of holding that cash. So people, oh yeah, it's great, I'm getting my stock bought back, and yeah, it's going to run the stock up. Well, yeah, no, it doesn't, because when you understand what's really going on under the hood, it's a bit of bait and switch.
Okay, let's end here, Melody, if that's all right with you. Mitch, if that's all right with you, if we could both of you answer this final question. I think this is great, kind of summing up everything that we went over, and we'll take one more market breakdown. But this is from Jade. Thank you for asking this question, Jade. I just signed up for an IRA with my job this year, and I'm feeling nervous about continuing to put money into it. Do you have any advice? Melody, can we start with...
Let's start with Mitch, yeah.
Ooh, Mitch, you're in high demand, brother. What do you got, man? What do you got for Jade, Mitch?
Okay, first of all, if you have an IRA with a company, that company is supposed to have a list of the investments that IRA is going into. So if you're participating in that IRA based on your income stream, and you do not know where that money is going, a certain percentage should be in bonds, a certain percentage should be in stocks, and then you've got to look at how long you're going to be with the company and how long does the thing vest for. If you don't understand anything that I just said, you probably have no business putting your money in that IRA until you understand what's going on. I will point out that, as you have seen by these corporations and these big pension funds, such as Caisse de Depot out of Montreal or CalPERS in New York, IPERS in Iowa, they take that money and then they invest it in stock markets or what have you. But if they are making unilateral bets in those stock markets without any ability to hedge or even understanding what a hedge is, there's a high probability you will lose your money. And it's just a question of when and not if. So they take your money, they make unilateral bets, and you have no protection. So then you would say, fine, where do I put the money? Well, you can put money in a bank just simply under a CD and get a yield on it without taking the economic chance of the stock dropping on you. It's not that stocks are bad. It's not that investments are bad. They're fine when you understand what it is that you're looking at. If you can quantify the probabilities of a loss, then you're good. If you can't quantify the probabilities of a loss, you have a job, you have no business putting your income at risk. And that becomes part of the pump. The stock market, everything you heard this morning from all these people yip-yapping on these shows, that's a pump. It's called a pump and dump. They're going to pump it up, take your money, and they're going to dump it, and you get nothing.
Melody?
Yeah, so I'll just add to that. So I totally agree. I think what Mitch is saying is really important. If you don't understand it, then you probably should not be investing in it. And so, the show isn't investment advice. We're not giving investment advice, but what we're saying is you need to understand these vehicles. And honestly, because what happened to so many people during the GFC with their 401ks, for instance, is, they just got half the value was wiped out overnight. People didn't even really know how that money was being deployed. And so what I would say there is don't be scared. Don't be fearful. Just do everything in your power to understand it. And then once you understand it and can make a risk calculation for yourself by looking at what, sort of a net present value cash flow model of, deploying that cash in this vehicle versus somewhere else, then that's when you can make a decision. And if nothing I have said, just like what Mitch said, has made sense, and you probably need a professional, but that's also very difficult. I know Adam Taggart's channel, they offer that free initial talking to a financial counselor. It's hard to find good ones there, but the best defense you're going to have is knowledge and understanding what you're putting your money into.
All right. Very good, guys. Now, just real quick before we let you go, just one more time. I can't say this enough. If you guys wouldn't mind supporting Melody, at least join her Substack. Subscribe if you can. Very excellent writing here. Very great information. And then when you're done with that, and I will put this into the description, and I'm really serious about this. If you guys have not signed the petition yet to help fight the fraud and corruption, please do so. You really can't cry about it unless if you do something about it, you can cry about it, right? You're putting the effort in. But please, you guys, don't forget Mitch Wexler and all he is doing for the people at his own expense, by the way. And also don't forget our buddy Jack, who had to go. Nobody special finance. In other words, guys, we're trying to do the best we can. We got a great group, great community here, great individuals here. Mitch, from the bottom of my heart, thank you. Melody, thank you for your time as well. To all the viewers, thank you for joining us for 3 hours. Don't forget to hit like, subscribe, share it. And other than that, guys, if you're out there investing in real estate, you guys already know we wish you luck and we hope you